And with regards to SIF, at AssetPlus, we have tried to equip our partners with all the required tools which will be necessary to get you equipped with the entire certification and start distributing SIFs, right? So, without further delay, I'd like to introduce Mr. Himanshu Arora. Mr. Himanshu is a leading trainer in the finance industry. He's been associated with NSE, BSE, and Ministry of Finance for all the different types of training programs, and he has more than 5,000 hours of financial training experience. He also regularly features on platforms like CNBC, Z Business, Bloomberg, and Reuters. So, I'll just introduce Mr. Himanshu. Uh,
I hope I'm audible and
yeah.
visible also.
Yes, Himanshu, you're visible. Over to you.
Sure. Thank you so much.
Thank you, Himanshu.
Yeah, hi everyone. Very good morning. So, I have already been introduced, but before we start, I would like to know, uh, I would like to first make a few requests. So, it is requested that you please carry a paper and a pen for yourself at all points in time, because there will be a lot of things that we need to write down. We will be talking about, we will be covering this entire module in greater detail. The name of the module is Series 13 Common Derivatives. So first, I'll give you an idea of what all we are going to cover or what all is generally tested in this module. And after that, we will be talking about, we will start discussing on the topics they are, which are generally asked. So this entire module, so yeah, if you have to sell this product called specialized investment fund, that's a new product which was earlier referred to as new asset class by SEBI. So that's a middle ground between the mutual fund and the portfolio management, wherein the mutual fund can be started with a very, very low amount, while the portfolio management services can only be availed with 50 lakh rupees. So this would require something around 10 lakh rupees. And then we are expecting some, updates to almost everything when when the product is launched. But not talking about SIF here, as in how the structure will look like. One thing is sure that it is mandated by the regulator that we need to, if we need to sell this SIF, then there is one exam that we need to clear. So that is what we are going to cover. And in the next few days, we are going to cover this entire program in this entire subject basically. So let me first introduce you to the subject. Then I'll be taking you through the subject, and there will be a few things that you might already be aware about the subject, about some of the topics, while there are certain things which I believe we hardly use in our common language, we hardly use in our professional journey of mutual fund selling or mutual fund distribution or even mutual fund investments. Rather, I would like to make a bolder statement here that even if we are an active participant in the stock market, even if we are a very, very active kind of trader and investor in the stock market, and we deal with this every now and then also there are a few things that one should be focusing upon to clear this exam. Talking about this exam first, so there are a few points that one should be taking a note of. So this program is basically a combination of three programs. So which means it's a three-in-one kind of program. So one, you need to clear equity derivatives. Basically, by appearing for just one exam, you will be clearing equity derivatives, or you will require a knowledge of equity derivatives, currency derivatives, and interest rate derivatives. So broadly, there are four topics that we all need to study to pass this exam. One is the capital market. Second is, which is common for all the modules. Second is the derivative product, and derivative as much depth as you can think of. And the third is currency concepts, as in the interest rate parity, the purchasing power parity, and the cross currency and the arbitrage and dealing with currencies practically, all these things. And then the fourth subject is interest rate, or the fourth topic is interest rates. So this is what we have to cover to pass this exam. Now, in our common parlance, we deal with capital markets, as in whenever we talk about, for example, a flexi cap fund or a large cap fund or a mid cap fund or something like that. and we deal with the economy, like for example the wars, the Israel-Iran tensions, the crude oil. These things we are very much well versed with, the index and so on and so forth. But then there are certain other things which we do not generally use in our common language, which is the currency, the cross currency. And ever since the RBI and the SEBI collectively have barred the currency trading, the knowledge of the currency market in the country has anyways gone down. So there are a few difficult things that we are going to cover in this program, while at the same time we'll be starting with the basic things. So you will be asked. The exam will be of basically 3 hours, which is 180 minutes. And the total marks for this exam, basically, the total number of questions will be 150 with 1 mark each. And the passing marks is 60%, which means 90 marks is what you have to score. But at the same time, this carries negative marking, which was not there in the mutual fund MFD test. So 1/4 is the negative marking, and 3/4 is the correct marking then. And 1 mark for every correct answer then. So 90 is the net marks that you have to minimum acquire there to pass this exam. And we have already covered the topics, discussed the topics that we are going to cover. And this entire program, I'll be covering in these 4 parts only: capital market, derivatives, currency, and interest rate. So these are 4 topics that we have to cover. And today we are going to start with the capital market, and we will be moving on to the derivative market, which is futures and options. But before I proceed, I would like to know by what means you will be able to talk to me, as in you will be able to send me a message. So everyone, can you please send me a message of hi or whatever you want to write in the chat box so that I know that you are able to chat with me. I'll be primarily using English language, but then if you want me to speak any statement in Hindi, you can simply just write H in the chat box. Rahul ji, at my end, the volume is high, the highest. I think you should, you may increase the volume at your end. Rajendra ji, good morning. Yeah, hi Shailendra ji. Hi Snehal. And yeah, I can see messages from Varadraj ji, Jerry, Ashwin, Vishwesh, Reji, Venkat. Okay, perfect, perfect. Perfect. So yeah, to begin with, it is a easy program, but as we proceed, the program is going to be, that would require a lot of your inputs. So let us now start talking about the capital market. And the capital market is relatively, or I would say, the easiest of all the things that we are going to cover in this entire program. Let me start sharing my screen with you first. Allow me a second. So I hope you all are able to see my screen. That's a blank Excel sheet for now.
Yes, Himanshu, it's visible.
Perfect. Okay, so let us start with capital market. So see, what we are going to cover today is the basics of capital market, and the capital market primarily comprises of, I'll be going by the book itself. And if you have any question, let me first. Snail, you will be getting some notes, you will be getting some MCQs. One second. I'm just checking all the chats. So that whenever I get a new chat, I should be updated about it. Just one second. Okay, perfect. So one can lower down your, yeah. Kumar Appanji, you have some question? Okay, you are, I need to unmute you, but you are able to chat, right? No? I think you are able to send a chat to host and panelist. A lot of you have already sent me a message. So now I'll let you know about the recording, but Riddhi, can you please check about the chats once? A lot of the participants are not able to send me the chat.
Himanshu, I think you can start with the session. Meanwhile, I'll also check the chat. Maybe, in between, you can check the chats one and you can start it now, right?
Yeah. That I'm starting.
Yeah. And I'm just checking with the chat box.
Sure. And someone has sent me a message that PM chats are on. So personal message is something I think that is on. Kumar Appanji, maybe you can try that.
Let me look at that and, I think we can start with the.
Perfect. In the meantime, I am starting and you may please keep a note of all your questions and doubts. So see, let us start with the very basic idea of finance, and I'll be sticking to the course here without assuming anything that you know some bit of it or not. So today we are talking about, or we are starting with the basic things. So you might be knowing a few things, but listen to me very carefully. So see, what exactly is finance? Here we are starting now. So what exactly is finance? Finance is primarily, so there are two kind of participants in the market. One is called saver and other is called a spender. There are certain example of savers. For example, the households or the individuals like you and me are the savers. Okay, so I think the chats are working now. So there are a few there are a few example of savers. One is household, second is corporations, and the third is government. So all these participants, they save in the world. So they save in their own world. Then there are certain people, I mean, these are the people who earn more than they can spend. And then there are certain other people who earn lesser, or maybe for some other purpose, they might be requiring some money. So the example of spenders can be the same people, for example, households, for example, corporations, and for example, governments. Now, these both participants can be domestic and both these participants can be foreign also. So which makes them six people. So domestic individuals, domestic corporations, domestic government, foreign individuals, foreign corporations, and foreign governments. Now the problem is, now the problem is that these people, the savers in, for example, India, they do not know that a corporation in the US, let's say Tesla, they need some money, which means there is a requirement of a channel. So you will be requiring a channel which will transfer the money from savers to spenders. And this is what we call as finance. So finance is the movement of money from savers to spenders. And this finance is of basically two types. One is financial intermediaries, or this channel is basically of two types. One is financial intermediaries and the second is financial markets. Guys, for the first 15-20 minutes or so, I'll be sticking to basics so that we all are on the same page, and then we'll be moving on to some level where we are asked these kind of questions. So one, we have financial intermediaries, and the second we have financial markets. Financial intermediaries, for example, banks, NBFCs, etc. But in this module, we are more concerned about financial markets, where you are asked most of your questions. Financial market comprises of something called asset classes. Now, what do you mean by an asset class? An asset class is something where you can park your funds. An asset class is something which acts as a store of value for you. So example of asset classes. For example, equity is an asset class. Can someone please write in the chat box, according to you, what all can be other asset classes? So we have debt as an asset class. We have commodity as an asset class. We have forex, cash, or currency as an asset class. Crypto has not yet been recognized as an asset class. Gold falls under commodity. Then you have real estate. Then you have certain alternative investments, for example, arts and collectibles, and so on and so forth. But we are more concerned about the asset classes which are primarily available for trading on exchanges. And in India, we have four products that are available for trading on exchanges. One is equity, second is commodity, third is debt, or also called as fixed income securities, and the fourth is forex. And let me tell you one thing, you will be asked question on all these financial markets, I mean all these asset classes which are a part of financial market. So we will be talking about all these four asset classes. Someone was asking me that which are the four topics that we are going to cover. So first we are going to talk about the capital market, then we'll be talking about the derivative market, then we'll be talking about the currency market and the interest rate market. So these are four topics that we are going to cover. And then, guys, can I say that hedge funds or derivatives, or for that matter ETF, they are also asset classes because you can park your funds here, yes or no? So these are also the asset classes. So no, these are a separate products which are actually called the products itself, or also called as derived products. So now we have got two things in financial markets. One, asset classes, and second, products. Tushar, you can give the NISM 13 exam as well as MFD, and you can work with both of them. And as of now, if you have any question, okay, let us set the pace for this, let us set the agenda for this entire program, at least for today. So we will be taking some short breaks after some time. And there, when we rejoin from the break or before taking a break, we'll be taking all the questions pertaining to the exam, or we can take all the questions pertaining to the SIF. But now, while we are talking about the course, we will be focusing on the subject matter itself. And you can ask me any question around the subject matter. I'll reply immediately, or anything which I'm going to cover later, I may defer it for a while. But then the questions about not pertaining to the subject, that we can discuss later. I hope that makes sense for everyone. Okay, perfect. And if I feel that it is going question heavy and less of concept, then maybe we can pause questions for a while also. That we'll see how we proceed. Okay, but yeah, one thing is very, very sure here, that I will be requiring your utmost attention for this entire course if you want to pass this exam, because this is basically at a higher level of, I mean, a slightly higher level compared to MFD, or even compared to equity derivatives, if you have cleared those exams. And by the way, before I even proceed, I want to know one thing from everyone. Which all NISM modules have you covered so far in your life? Can you please write in the chat box? And also, I'm assuming that you have already covered MFD. MFD you have already covered, so no need to write MFD. Anything else apart from this, those who have covered may write, please. Those who have passed any of the exam, like equity derivative or PMS, for example, IA1, IA2. Okay. Okay, Premji, great. Okay, Lokesh. So not many of you have cleared those exams. I can see just 3 or 4 or 5 of you who have cleared either the research analyst, but research analyst 15 we will not be requiring here. 8 wale concepts we might use it here. Series 1 wale concept we will be using here. That's it. Okay, perfect. So we have talked about 4 asset classes: equity, fixed income securities, commodity, and forex. Now let us start talking about all these asset classes. So let us set the agenda for the day. First, we will be talking about an introduction to all these asset classes, and then we'll be talking about the derivatives as a product. So this is something that we have to cover today. Okay, equity. So what do you mean by equity? And I will be talking to you from the standpoint that how the questions will be framed in the exam. So what is equity? Equity is basically the part ownership in the company. Why do people buy equity? People buy equity primarily for three reasons. One, capital appreciation. Second, dividends. Third, voting rights. So based on voting rights, there are different type of shares in the market. One is the share that have the voting rights, and the ones or one voting right per share, and the one that may or may not have one voting right per share, maybe less than one voting right, maybe more than one voting right. But primarily equity is purchased for three reasons. One, capital appreciation. Second, dividends. And third, voting rights. The dividends are declared by the company, or the dividends can be declared by the company in a year as many times as they want. So we have three types of dividends. One, interim dividend, the dividend which is declared at the end of the quarter. Final dividend, the dividend which is declared at the end of the financial year. And special dividend, the dividend that can be declared at any point in time. So once I have discussed about a concept, to start with basics, I'll be taking a pause for 30 seconds. In the meantime, you can ask me those questions, whatever you have piled up. So again, I'm saying, so equity we are talking about. Equity is a part ownership in the company purchased by the people or participated by the people for three reasons. One, capital appreciation. Second, dividends. And third, voting rights. Voting rights can be of, or the shares can be based on voting rights. We have DVR, we have NVR, we have an ordinary share. And then you have dividends. The dividends can be of different type: interim dividend, final dividend, and special dividend. Now the question arises that why does a company issue equity? The company issues equity primarily for five reasons. One, expansion. Second, diversification. Third, debt repayment. Fourth, working capital requirement. And fifth, exit option for initial shareholders. Expansion, diversification, working capital requirement, debt repayment, and exit option for initial shareholders. Guys, you will be getting some notes, but not everything which I'm speaking is from the notes. I'm taking more elaborative. So I request everyone that you should be taking down some notes here. And I will be writing some of the important points in the Excel sheet here itself. No, the capital expansion and the working capital requirement, or the capital, what do we say? I did not use the word capital expansion. Yeah, I mean, as in say, the expansion can be in different forms, Kumarji. It can be based on acquisition also, while the working capital is not the acquisition at all. So capital expansion is a very wider term, while working capital requirement is basically how we run the company. Okay, so now what we have discussed is, why do we buy equity? Why does a company issue equity? Now the question arises that where does a company issue equity? A company issues equity on exchanges. And let me write down the five reasons why a company issue equity and why do we buy equity. So one, these are asset classes. Second, these are derived products. I'll be sharing this working Excel with you all. Then we talked about why we buy equity. We buy equity primarily for three reasons. One, capital appreciation. Second, dividends. And third, voting rights. Please keep taking down the notes. And why companies issue equity. One, expansion. Second, diversification. If there is some similarity between two reasons, it will be from in expansion and diversification. Expansion in the same field is called expansion. Expansion in a different field is called diversification. Then you have debt repayment. Then you have working capital requirement. And then you have exit option for initial shareholders. Now the question arises, where does a company issue equity? A company issues equity on exchanges. There is another question that the book answers is, how does a company issue equity? So one, where, why, and how. So first let us talk about where. So the company issues equity on exchanges. Now what are exchanges? Exchanges are basically the platforms where financial securities are traded. And exchanges can be of different types. One, stock exchange. Second, commodity exchange. Third, forex or a currency exchange. Fifth, bonds exchange. And fifth, universal exchange. So there are 5 different type of exchanges in India and across the world: stock exchange, commodity exchange, currency exchange, bonds exchange, and universal exchange. Now, because this book, basically this exam covers all the 5 aspects, primarily the stock, forex, and the bonds. So it also takes this concept very seriously about the exchanges. So in India, we have a few exchanges, for example, National Stock Exchange, Bombay Stock Exchange. In the world, we have NYSE and different other stock exchanges. And then there are certain commodity exchanges also where the commodities are traded. For example, on NSE, BSE also, we have the commodities available for trading. But at the same time, we have MCX, we have NCDEX. And then you have Forex exchange, which is NSE and BSE, bonds exchange, which is NSE and BSE, and of course the universal exchange then becomes only the NSE and BSE. So in India, you have NSE and BSE as the universal exchanges. Stock exchanges are also the same, but in the commodity segment, we have certain other exchanges also, which are even larger than the NSE and BSE. So far what we have discussed is, one, what is finance? Finance is the movement of money from savers to spenders. These are the example of savers. These are the example of spenders. Now, this finance comprises of 2 channels. One, financial intermediaries, which we are not concerned about. Second, we have financial markets. Financial market comprises of something called asset classes. What do you mean by asset class? An asset class is something where you can park your funds. For example, you have equity, you have commodity, you have currency, you have bonds, you have real estate, etc. But we are only concerned about the asset classes which are traded on exchanges, because we are going to deal with the products which are available for trading on exchanges only. And then you have certain products, and this particular module talks about one of the products also in very much detail, and that is called the derivatives. Why they are not called the asset classes? Because the value of all these products or derived products, they require these products existence, while these products can, or these asset classes can exist independently. So hence they are dependent on this product. So then we started talking about equity. What is equity? Why do we buy equity? Why does a company issue equity? Where does a company issue equity? And we have talked about 5 different types of exchanges. I am taking a pause for 30 seconds here. If you have any question on whatever we have discussed so far, please feel free to ask in the next 30 seconds. Prabhu, HF is hedge funds. Universal exchanges are those exchanges where all the products which are available in the country for trading are traded. For example, on NSE, you have stocks. On NSE, you have bonds. On NSE, you have commodities. So you have, Forex also. Got it? I can show you these examples, but these are too basic. I think you will be able to check it by yourself also. These are households or let's call them individuals. FM stands for financial markets. And HS stands for households or individuals. Preet, you will be getting certain notes, but they will be more holistic in nature, as in a broader level in nature, that will help you go through them before the exam. Not each and everything that I am discussing will be there in notes. So that is why I requested to please be very active in this module while attending it. Example of financial intermediaries can be banks, NBFCs, etc. I hope I've answered all the questions. Please explain finance is saver to spenders. So finance is the movement of money from savers to spenders. Yes, the energy exchanges come under the commodity markets only, and the FIS stand for fixed income securities. Perfect. Now let's proceed here. Now the question is, how does a company issue equity? And this question is an important one. How does a company issue equity? The company issues equity. Prem, the money market becomes the part of the bond market itself. The concept remains the same. Now, how does a company issue equity? A company issues equity by two different ways. One, privately. So one, privately, and second, publicly. What is a private, or how does a company issue equity privately? The common myth says that whenever the company issues shares to some people around us, it is called, or to some of the individuals or the institutions, then it is called a private placement. Contrary to this common belief, there is a technical definition of private placement. Whenever the company issues equity, and you may please listen to this very carefully, whenever the company issues equity to less than 50 people at one point in time, or to less than 200 people during a year, this is called private placement. And whenever the company issues equity to more than these number of people for the purpose of raising capital, it is called public issue. So privately, less than 50 people at one point in time or less than 200 people during a year, it is called a private placement. And when the company issues this equity to a large set of population for the purpose of raising capital, then it is called a public issue. Example of private placement can be, and this question was in my exam, my personal exam, when I appeared for this. So which of these can be the private placement? Sorry, which of these are not the private placement? That was my question. So, but for example, the private placement can be QIB or individual issuance of shares. What's more important for us, which happens in the public domain, is the public issue. Example of public issues are IPO, FPO. Can someone please tell me more examples of this? IPO, FPO, any more examples? Kumar Appan sir, I'll be taking all the questions during those 30 minutes break, please. Abhi ke liye, I will be talking about a concept and I will be asking you some questions. So one, IPO, second, FPO, third, rights issue, fourth, offer for sale. I am not stopping to write here and I'll be asking you the question which I was asked. So IPO, FPO, rights, OFS, bonus issue, employee stock ownership plan, buybacks. Some of these were given to me. I do not specifically recall which were given to me stock split. Now you please tell me which of these are not a public issue, and your answer should be in one line, because it will come to me as broken otherwise. So answer to me in one line, which of these are not the public issues? Which of these are not the public issue? My question is about are, not is. So there can be more answers to it. Okay. I have got many answers, but I do not think most of them are, I believe most of them are wrong. Maybe a couple of them are correct. Okay. Now please check your answer. I hope everyone has written. Now please check your answer. This is a public issue. 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 This is just a corporate action, not a public issue. This is a corporate action. This is a corporate action. This is a corporate action. So the correct answer should have been from your end. Those who have written bonus, ESOP, buybacks, and split, all four of them is the correct answer. Did we get anyone as correct answer here? So these are the public issues. Great, Pramod and Prem. Okay, Amol. So these are the public issues, and rest all are the corporate actions. What is QIB? Someone asked me this question earlier. So QIB is when a company issues shares to a very small number of participants who have got a very large monetary base. Then you have venture capital, you have angel investment. All these are private placements. If I write them here also, so they are not public issues, these are private placement. Sounds good? So now I will be taking a pause here. Okay, so let us do one thing. Before taking a pause, let me explain all these terms first, right? Make sense? Because some of you are asking me these terms. So first, let me explain them, and then I'll take a pause for your questions. What is IPO? Please listen to me very carefully. Again, I'm saying it's an important topic. So what's an IPO? Whenever an unlisted entity issues shares for the very first time and becomes part of the public domain, the listing space, the listed space, it is called IPO. So whenever an unlisted company issues shares for the very first time to the common shareholders, as in to the common public, to a large set of population, then it is called IPO. Whenever an already listed entity does so, it is called FPO. Whenever a listed entity issues shares only to the existing shareholders, it is called rights issue. Whenever not the company but the existing shareholder, they sell the share to the common public, as in the large set of shares, the large chunk of shares, it is called offer for sale. When the government does this offer for sale, we generally call it as disinvestment or divestment. Whenever the company, instead of giving you dividend in the form of rupees, in the form of cash, it gives you in the form of shares. Like for every 10 shares, you are given one extra share. It is called bonus. Whenever a company's employee or a certain number of employees, whenever these employees receive shares from the company, this is called employee stock ownership plan. This is not even a public issue, even though it's a corporate action. But then in this case, the company is not raising capital, rather the company is buying back the securities. In stock split, the company, for example, if the stock price has become too heavy or too high for people to participate and the liquidity is drying up, in that case, the company goes for a stock split So it reduces the face value of the company. What is face value? We are going to discuss in a while. Then what is QIB? Already discussed. What is venture capitalist and angel investment? Similar kind of term. Company's initial capital raise is through angel investment, and then later on the venture capital kicks in. But they are not important for us. What's important for us? We can be asked questions on these. So I hope these are clear to everyone. I'm taking a pause for 30 seconds. Anyone, any question, please feel free to ask. OFS and FPO. In OFS, the shareholder sells the shares, not the company. While in FPO, the company sells the shares. OFS can be for the new company also, while the FPO can be for the old. FPO can only be for the older company, the already existing company. FPO stands for further public offering or follow on public offering. Okay, there are many questions. Offer for sale is clear to everyone, right? So let me give example of offer for sale. If, for example, IRCTC wants us to, or the government sell their stake in IRCTC, that will be called as OFS. When Paytm's Vijay Shekhar Sharma sold the stake in Paytm, when he sold the stock, when Radhika Nair sold the stock in Nykaa, or when the government might be selling stake in IRCTC or whatever, I mean rights or some other government company, then it should be called as OFS. In rights issue, the company issues shares only to the existing shareholders at a slightly lower price. Rajeshji, I think you are talking about the buyback, right? Sorry, bonus, right? Yeah, in bonus, for example, the company has got some cash. So company, instead of giving you cash as bonus, sorry, dividend, company puts this money in the reserves of the company, and basically some other technicalities involved, which I'm not going into. So the company keeps this cash and issue fresh set of shares. And these fresh set of shares are issued to Rajesh ji, Vikas ji, Avdesh ji, everyone, those who are already holding the shares of this company. This is called bonus. So for every 5 shares of IRCTC, hypothetically, you are given 1 extra share. That is called a bonus share. Is OFS done at a fixed price range or IPO? It can be through any of these ways. Both are common parlance. And Kumarappan has a question, private placement 50 into 4 times? No. So what is private placement? Whenever the company issues shares to less than 50 people at one point in time, then it is called a private placement. Now it can be done 3 times in a year. It can be done 4 times in a year. So 30 times 4 times in a year, 30 shares 4 times in a year. That's fine. Or 30 participants 4 times in a year. That's fine. But whenever the number exceeds 200 during a year, then the company will have to go to SEBI and take a permission for public issue. Because the fourth one, if it is beyond 200 people, participants basically, then it comes under the ambit of SEBI and you have to take a permission. Kumarapan, clear? Why company buys back the shares? Company has got some cash. They want to use this cash to reduce their equity float in the market. So that will increase the value of everyone's equity because now the shares trading in the market are less in number, right? Though I personally believe that I have answered all the questions, but is there any question that remains unanswered? Okay, why company going stock split? So Bajaj Finance, for example, was trading at 20,000 rupees. Now it becomes significantly high price for people to participate. Because of this, the liquidity in the shares will dry, right, Preet? To avoid this kind of scenario, while the companies want people to participate in their equity, that is why the equity prices will go up. They expect this to go up like that only. So उन्होंने शेयर प्राइस को कम कर दिया, they reduce the share price. So basically there is a price called, which we are going to discuss next. It is called face value. So they reduce the face value. Preet, I hope that answers your question. Yes or no? Amol says equity float. Equity float means, for example, there were 100 shares floating in the market. Now they want to reduce it to 80 or 70. This way, everyone's equity prices will go up, right? Because the number of shares, or everyone's uh, earning per share will go up, because there are less number of shares in the market now. Sounds good, Amol? I'm taking those questions which were left earlier. Rangarajan sir says, in what situations company do stock split or bonus issue? Technically, what is the difference between them? Bonus is basically a way of giving dividends, nothing else. So instead of giving cash to your daughter or son, you are giving them a chocolate. That is what bonus is basically, right? But stock split is a slightly different thing. In stock split, they split the share. So that $20,000 share is now trading at 10,000 rupees. But now Rangarajan is holding 2 shares instead of 1. So earlier I was holding 1 share of 20,000. Now I'm holding 2 shares of 10,000. Sounds good? In bonus share, value is reduced. Why? Because the number of shares increase in the market, right? So that's a very natural thing. Earlier 100 shares were trading, now 200 shares are trading. EPS up due to buyback, guys, we will be limiting to those topics which can be asked in the exam. Even though right now I can answer a few questions because these are very, very basic questions. But later on, when we start with derivatives today, please be particular about the topic. Issue of preference shares or convertible shares, where they will be clubbed. Hari, I think we can skip this question, or maybe we can take this question later. Just keep handy, guys. Please keep handy with a paper and a pen or a word file, jahan par you can write these questions which I'm skipping for now. I would like to answer all your doubts or questions, but I would like to take a priority of those questions which are pertaining to the subject. Okay, Hari, make sense? Because no, that can be an important question for the exam also, that the value remains same in the stock split. The net worth of the company remains the same, but the stock price will come down, the face value will come down. And split is not generally, or not always 1:2. It can be 1:10 also, it can be 1:20 also, something like this. Amol, clear? Perfect. So I hope we have answered all these questions. Let me take a test here. In bonus, the face value is not divided. In split, it is. That's an important question. Okay, let me ask you a question now. Not exactly this can be asked in an exam like this, but this will give you a better understanding. Wait, I am framing a question for you. Guys, in all these boxes, you can only write these 4 terms: new, old, both, or none. In all these boxes. Sounds good? Wait. Yes, tell me. What should I write in IPO? Everyone, please be very, very quick now. In IPO, okay. Wait. Let me put it this way. A new company is the one that has come to the stock market for the very first time, not newly generated, not newly formed, the newly listed, or the one that is unlisted so far. The new shares are the ones which are issued by the company, and the new shareholders we are already aware of. So in IPO, the company is certainly new. The shares are quick. The shares are new only. And the shareholders are new only. So in IPO, the company is new. A new company which was unlisted earlier comes to the share market, issues fresh shares to the new shareholders. Sounds good to everyone? In FPO, the company is certainly old. The shares are new. The shareholders are actually it can be both. Actually, it can be both, but then rights is primarily for old shareholders. So let me write here both. The rights, the company is quick, old. The shares are new. The shareholders are certainly old. In OFS, the company is all of you are wrong. It can be both. Hari, you are right. Rest all were wrong. It can be both. Why both? Because an unlisted company, for example, NSE, can share issues. I mean, the promoter of the company can sell shares. That's an unlisted one, while IRCTC can also do so. The shares are it is the only public issue where the shares are old. And the shareholders, depending upon the company types. So this is the correct interpretation of all these terms. This is an important topic in terms of equity for capital market. Am I clear? Now we will be talking about some of the topics which cut across all the asset classes. So far, we were talking about only an introduction to equity. Now we will be talking about certain topics which will be cutting across all the industries, as in equity market, commodity market, debt market, forex market, all these markets. Sounds good? So whatever we have discussed so far, let's pause here for a 10-second time here. So whatever we have discussed so far, is everything clear to everyone? Yes or no? And also let's try to introspect. I hope we are going at a fine pace. You all are able to catch up. Though the topic is relatively simpler compared to what we are going to discuss in this entire program, but that is by choice. I want to start with such a topic so that everyone can catch up at a later phase. Can you explain rights? In rights, the company issue shares only to the existing shareholders, Surinder. So, for example, Reliance wants to issue shares to public at 100 rupees, hypothetically. Instead of it, it says that I can issue my shares only to the existing shareholders at 95 rupees. Why they are giving me a discount? Because that will save them a cost of flotation cost. तो वो IPO लेकर आते सुरेंद्र तो उनको पैसे ज्यादा लगते. They would have to give money to investment bank. इसीलिए they are giving me a discount. Last question before we start the next topic. Could you please explain OFS by some example? Neeraj, whenever the company's promoter sells the shares to the common public, it is called OFS. Think about any disinvestment. IRCTC, HAL, Cochin Shipyard, all these companies were nothing but OFS. LIC was an OFS. Paytm was primarily an OFS. Neeraj, clear? Perfect. Vijayaraj, I am not the best person to answer this question. Maybe I'll request someone from the AssetPlus to answer your question later. Okay, let us start with the next topic. And after this topic, we are going to take a quick break. So I want everyone's attention here. Now we have talked about what is equity, why do we buy equity, why does a company issue equity, where does a company issue equity, how does a company issue equity. All these topics we've answered. Now, how can we buy equity? We cannot deal with exchanges, right? We deal with someone called brokers. Who are brokers? Brokers are basically intermediaries which help you facilitate the transaction. So you will be facilitating a transaction using brokers only. Though, important point here, you may take a note of it, though you can bypass the brokers also by purchasing a service called DMA. You and me cannot do so, but there are some people who can do so. You need a lot of capital for that. And of course, you need a reason for that. But otherwise, all of us have to deal with the brokers. The brokers are of two types. The brokers are of two types. One, discount broker. Second, full service brokers. Guys, also before we proceed, let us set the agenda for the day. Whatever we have discussed in the name of basics is something that we have already covered. Broker is something we are talking about. Next, we are going to talk about a very important term, a very important topic, which is the entire capital market terminology. That will cover almost everything in capital market. After that, we will be talking about index, and after that, we will be starting with derivatives. And by the end of this, end of the day today, by afternoon, the session is going to pick up. I'll be coming to that. Wait for a while, Arun and Varadraj. So the topic is going to be very, very interesting, intriguing, and somewhat difficult also. So what we are discussing is complete basics, but with time, the level is going to be increasing here. So that is why I request everyone to pay complete attention. And please make sure that you are taking notes at all points in time. Okay, so the brokers can be of two types. One is discount broker and other is full service broker. See, listen to me carefully here. The brokers, if you have a broker account, I believe that you would agree with me that you require certain services from a broker. What services you require from a broker? One, trading platform. One, trading platform. Anything else that you can think of, guys? One, trading platform. Second, risk management service. Third, research and advisory services. And fourth, miscellaneous services, for example, check collection, etc., etc. Now, which services do you think are the most important ones, jinke bina we cannot proceed? The one and the two services are the most important ones. So the broker which provides you only the first two services are called discount brokers, and the brokers which provide you all these four services are called full service brokers. The charges of discount brokers are relatively less, and the charges of full service broker are relatively higher because they are providing more services. Pausing here for 10 seconds. Anyone, any question? I hope this is fairly basic. RMS stand for risk management service. Example of discount brokers, though it will not be asked in your exam. So example of discount brokers can be Zerodha, Dhan, Upstocks, etc. Example of full service can be Motilal Oswal, Sher Khan, yes, ICC Direct, Axis Direct, Kotak Securities. Kotak is both in both actually. Clear, guys? Okay. Rahul, I should be audible to you, right? Guys, I am audible to everyone, right? Okay. I'm explaining all of them. So trading platform is already you know, right? RMS is risk management service. Like for example, taking care of your shares, taking care of your dividends, taking care of your leverage requirements, taking care of your margin requirements. All this comes under RMS. Research and advisory. Interestingly, by the way, let me tell you one thing. Shailendra says one request to Himanshu. Whenever you give answer, please say the same instead of 1, 2, 3. 1, 2, 3. Okay, okay. You mean to say I should be speaking out the question first for you? Okay, okay. Okay, cool. So I was speaking something. Yeah, interestingly, this topic is less of a part of equity market or capital market. These are the questions that come under derivatives market, equity derivatives that we are going to cover later also. So trading platform is, we already are aware of. RMS we have already covered. Research and advisory is when the broker gives you and publishes the reports to buy and sell certain shares or sectors or economy. And then miscellaneous are certain miscellaneous things like, for example, check collection or call and trade facility or some extra customer support or something like that. So these are 4 services given to you by full service broker, out of which the 2 services, trading platform and risk management service, are given to you by discount broker. And the examples we have already covered. Now there is one question which I am doing here. So these days, this type of question is not being asked in general. But this question was a very, very common kind of question earlier. So I'm not sure whether you will be asked this question or not, but there's no harm of learning a concept here. But for the last few years, I have noticed, based on the candidates who have appeared and myself have appeared many times in different exams, this question was not part of it. But yeah, certainly was part earlier. So see, for example, listen to me carefully. Reliance is trading at 1500, and let us say you bought 1,000 shares. You bought 1,000 shares at 1500 and you sold them all at, let us say, 1600. Now, discount broker charges are, the charges levied by discount broker are 0.01% or 20 rupees, whichever is lower. And the brokerage charge by full service broker is 0.02% or 100, whichever is higher, because this broker is providing you more services, hence the charges are higher. Now, how to do these kind of calculations? First, calculate the transaction value of buy and sell. What is the net profit loss calculation in this entire case? So you have made a profit of 1 lakh rupees, but this is gross profit. On this, you have to pay the transaction charges. For discount broker, I want everyone's attention, please, guys. For discount broker, this 15 lakh multiplied by 0.01% is 150 or 20, whichever is lower. So the brokerage is 20 rupees. Is this point clear to everyone? Yes or no? How did we reach 20? And in this case, this multiply by again this or 20, whichever is lower. So 40 rupees is the brokerage that you are paying. So minus 40. So my net profit becomes 99960. Clear, guys? So for a discount broker, your net profit comes out to be this. While for a full service broker, let me do it here again. For a full service broker, equal to this multiply by this or 100, whichever is higher. So the higher is 300 and equal to this multiply by this or 100, whichever is higher. So gross profit this minus 620, 99380 is the net profit for full service broker. Sounds good to everyone? Interestingly, the sell can be splitted into different tranches. You sold 100 shares here, 300 here, and rest here. 620 is the brokerage that you pay, Kumar. 1 lakh was the profit. In this case, 0.02% or 100, whichever is higher. The higher was 300. So 300 plus 320, 620, 1 lakh minus 620, 99380. Clear to everyone, guys? Repeating it again for full service broker. 15 lakh multiplied by 0.02%. 300, 300 or 100, whichever is higher. 300. So the net brokerage on the buy side is 300. 16 lakh into 0.02%. 320. 320 compared to 100, whichever is higher, because this one demanded the higher one. Clear, guys? Anil ji, Vijay Raj ji, Rajiv ji, everyone clear? Cool. So after the break, we will be taking a break now, but wait for a while. We will talk about introduction to commodity, currency and bonds. We are going to cover later in greater detail. So we will be skipping that topic here for now because we have to talk about in very much detail about these topics. And then after that, we will be starting with the terminology. Then index, then derivatives is something that we have to start. Guys, it's 11:22. I think 5 minutes is sufficient. We will be taking multiple breaks. Do not worry. We'll be taking a larger break also for maybe 15-20 minutes or so. But so far, let's say it is 11:23 now. So we are meeting at sharp 11:30 and we are starting at 11:30. Perfect. Prabhu, we will be together with your permission. We will be together until 2 o'clock. Right after the session, you will be very hungry for the lunch. Until then, I want your complete attention. Thank you so much, guys. So we will be meeting in 7 minutes from now. Amol, yes, you can expect anything and everything which I am showing you. Everything is for you only. I'll make, I mean, I'll try. I'll just have to figure out how to share this Excel sheet with you, but I will for sure. What is 20 in this Excel sheet? Prabhu says this 20 was for the discount broker. Those who are back may please write yes. Okay, cool. Sorry, I couldn't finish my tea during the break, so I'll be having alongside. So, perfect. I hope we are sorted for now. Now let us start talking about the second asset class, which is commodity. Frankly speaking, commodity pay, there will be less number of questions, hardly any one question. So that is why we are not going to spend much time on commodity. I'll just give an introduction of the commodity. That's the only thing. There can be questions around the application of commodity. Like for example, if there are wars, what will be the impact on gold or crude oil? This we are going to cover later also, for that matter, the fundamentals of the Forex market. There also we talk about gold and certain other commodities, a brief introduction. But then again, not more than one question on commodity. But yeah, there can be more than one question on the economic parameters that we are going to discuss later. We have a around 50, around 30, 40, 50 minutes discussion on this topic also. Okay, so commodity. What do you mean by commodity? Commodity is something that can be consumed, or commodity is something that acts as a raw material. Avni, now that we have not started the question, let me answer this question. So Avni, please drop this message to someone from AssetPlus. You can see the wallpapers there. About the recording, I'm not sure. About the subject matter, you can ask me all the questions here. Okay, so let us start this topic now. Talking about the commodity. Commodity is something, as we discussed, something that can be consumed, something that acts as a raw material for some other product. Like for example, tea. For example, the tea which I am drinking right now is not a commodity. It's a finished good or the finished product. But the raw material tea, the ones that you grow in the garden, that is a raw material. Silicon is the raw material for glass, though it is not traded, but then it is the raw material. That's a commodity. Wheat is the commodity. Rice is the commodity. Gold, silver, copper, nickel, lead, zinc, aluminium. These all are commodities. The commodities can be perishable or non-perishable. I believe everyone knows what is perishable commodity and what's a non-perishable commodity. The commodity has another segregation, which is tangible and intangible commodity. Okay, interestingly, can you please mention some intangible commodity? Let me tell you something really interesting, which you might not be aware. Kumar Appan, art is a tangible product. I mean, the value of art is intangible, I understand, but the art is tangible. Alan, brand value is a accounting commodity, not a financial commodity. I'm talking about the financial commodity. Patent is again, Rajesh, by mistake, you write patient. Nevertheless, but patent is a accounting commodity, not a financial commodity. Okay, let me give you a hint. You get it alongside crude oil. When you dig for the crude oil, you get this intangible commodity. Quick. Natural gas. Absolutely right. Natural gas is an intangible commodity that is traded in the financial markets also, and it's a leading indicator of the economic cycle for that matter. Again, a topic to be discussed later. By the way, do you know, interestingly, do you know weather is also a commodity? And by the way, do you know that weather is also traded? Do you know weather is also traded on exchanges? Not on Indian exchanges, but then the weather is traded. Rainfall is traded. Yes, Hari, weather derivatives. Very interesting product available in US. अब प्रीत हम उसके बारे में तो बात नहीं कर पाएंगे आज, that how it is traded, But yeah, maybe in derivatives we can have a brief discussion on this. I'm not sure. I'm not promising you. Depends upon how much time we have in our hand. Water derivative is a recent product, because right. But then water is still tangible. Okay, cool. So commodities, let us come back to the topic. So commodities, tangible, intangible, perishable, non-perishable. But the formal segregation of commodity or the formal classification of commodity is hard commodity and soft commodity. Kaushik ji, Bitcoin is not being recognized as a asset class as of now by most of the countries in the world. That is why we have not even talked about Bitcoins in the asset classes itself. So again, not in derivative, not in commodity also then. So, but the important segregation is hard and soft commodities. Perishable commodities are, for example, fruits and vegetables and milk, meat products. Non-perishable are gold. Gold does not perish. Silver does not perish. Metals, crude oil. But the most important segregation is hard and soft commodities. Acha, I have an interesting question here. Is crude oil a hard commodity or a soft commodity? What is your thought process, initial thought process, before I talk about the definition? Crude oil is a hard commodity. You know why? Listen to the definition of hard commodity. The commodities that you find below the ground, the ones which you mine or extract, these are called hard commodities. And the ones you find above the ground are called soft commodities. So all the metals, be it precious metals, be it industrial metals, they all are hard commodities. Energy products are all hard commodities. Alloys, hard commodities. Ores, hard commodities. Minerals, hard commodities. Soft commodities may all the agriculture products. Wheat, maize, barley. Neeraj, Neeraj has a point here. Potato is also underground. So that is why, Neeraj, I repeated the statement again. The ones that you mine or extract. I was expecting this question or answer. So the ones which are mined or extracted, you do not mine potatoes, right? Okay, cool. So we are more concerned about hard commodities. Now, important point, hard commodities are important for us from economic standpoint, as in whenever the economy takes a downturn, like for example, whenever there is a war like situation like today, so crude oil prices will be impacted and the economy will be impacted. So hard commodities are very important from economic or financial standpoint. Soft commodities are important from consumption standpoint. Cool. So that is the only thing that we need to study about the commodity for now. You should be knowing about perishable and non-perishable commodity, tangible and intangible commodity, hard and soft commodity. Hard and soft commodity is something that you should be bothered about. The ones that you find below the ground are called hard commodities, and the ones that you find above the ground are called soft commodities. This topic is over. Anyone, any question? Then we are going to talk about a very, very important topic. Important as in that's more exhaustive. Quick examples of tangible, intangible. Tangible commodities are gold, silver, copper. जिसको भी आप touch कर सकते हो, they all are tangible commodities. The ones that you can touch and feel. The ones that you cannot, for example, weather, natural gas, they are intangible. Perishable, fruits, vegetables, milk, all the soft commodities, and non-perishable, all the hard commodities. Pramod, I made a statement here that any war-like situation, any financial crisis, any COVID-like situation, all these impact the crude oil and the gold and all the metals. So from economic or financial market standpoint, hard commodities are very important. From you and me, as in yours and mine's individual standpoint, consumption standpoint, soft commodities are important. So Prabhu and Pramod, I've answered your question. Make sense? Clear? Gold is a hard commodity, Preet. Absolutely. Cool. So now let us start talking about a longer topic, which is terminology. Let us write about all the terms first, then I'll show you all these terms practically. So one, face value. One, face value. Second, OHLC. Third, LTP, CMP. Fourth, there's a discussion of this term VWAP, which was not earlier in the module. They have recently added this term VWAP. Then the next term is traded volume. Traded value. Market cap. Types of market cap. Types of companies based on market cap. Short selling. Price bands. Order book. Order management system. Index. Perfect. ये cover करने तक we would have covered until this topic. Anish, open interest we are going to discuss later. Okay. Face value. Rajesh, which ratio? Sorry. That you do not require. I mean, we are not going to discuss that. Out of syllabus. Last 10 minutes, I'll open the floor for any kind of questions. If you have any question around any other topic, you can feel free to ask me, but that is only for the last 10 minutes of all the sessions there, or maybe some of the longer sessions. But during this entire, course, we will be talking about only the topics which are part of the curriculum. Okay, face value. So what is face value? OMS stands for Order Management System. This topic I'll be keeping for the later period. I'll see what needs to be covered first, order management systems or derivatives. Okay. So what is face value? Face value is basically, guys, now I will not be taking any question until I open the floor for questions. Please do not write any question unless until it is very, very important that you are not able to understand a concept. Only then you will be asking me a question. Otherwise, after around 10-15 minutes or so, I'll open the floor for questions. And I might not be looking at the question section for now. I'll be focusing on these topics first. Face value. But please keep handy your questions. They all are very important. So whenever the company issues shares for the very first time, okay, let us understand it this way. So whenever a company is formed, hypothetically, let's say there's a guy called Nikhil, and Nikhil goes out and he has an idea. He goes to ROC, Registrar of Companies, and he tells ROC that I have an idea, I want to start a company. Let's call it Nikhil Consultancy Limited or Private Limited. So now, the humans being humans, we do not give anything to someone without any expectation in return. Do not take it otherwise though. But then, for example, our guy, let's say ABC, he goes to the ROC and he has got 1 lakh rupees and he gives this 1 lakh rupees to the company. In return, he's expecting something from the company. What he's expecting, ROC says that the company, like the humans are made up of cells, the company is made up of shares. So you can take all the shares or you can take some shares. So the shares, for example, the 100 shares or for example, 10,000 shares against 1 lakh rupees is what he receives, ABC receives. And hence this one share is currently costing rupees 10. This 10 rupee of value of a share is called the face value. It is also called the nominal value per share. Does it represent true value of the company? May not be. Will you always receive this amount of money whenever the company goes bankrupt or whenever the company winds up the operations? May not be. May or may not be. Maybe higher, maybe lower, maybe nothing. Then what is face value required for? Neither it tells you the net worth of the company, nor you will be receiving this money whenever the company winds up the operations. Then why do we need this price? Why do we need this number? We need this number to declare all the corporate actions. So dividends are declared on face value. Dividends are declared on face value. So the company says that my dividend is, for example, 100%. What do you mean by 100%? 100% of the face value. So the dividend is 100% of 10 rupees, which is 10 rupees, and the company's share price is, let us say, 1500 rupees. So the company's dividend yield becomes important term. Take a note of this. Company's yield becomes 10 rupees divided by 1500. It comes out to be 0.67%. This is called dividend yield. So to declare the corporate actions, for example, the company does not split the stock price. The company splits the face value. The stock price adjusts automatically. So to declare these corporate actions, the face value is required. And then these corporate actions may have some implication, for example, calculation of dividend yield. But if someone asks you that does face value represent the true value of the company? Absolutely not. Will a shareholder receive the face value whenever the company winds up the operations? Absolutely not. The face value is only used for declaring the corporate actions. And this is one of the example of declaring corporate action. For example, there's one more example. Bajaj Finance was hypothetically trading at 10 rupee of face value. And the stock price was 20,000 rupees. The company says that and for example, someone is holding one share of Bajaj Finance. Now company says, I am reducing the face value of my share from 10 rupee to 1 rupee. So instead of 10 rupee face value wala 1 share, now you have 1 rupee face value wala 10 shares. So now because you have got 10 shares, why would the share price be costing 20,000? It would be costing 2,000. That is how the face value impacts all of us, not directly, but indirectly. Just simply write yes in the chat box if this point is clear to everyone. Okay. For some of you, I'm explaining the concept once again. Face value is what you have to remember. Face value is the nominal value per share, the value written in the books of accounts of the share. In the balance sheet, it is mentioned that this is the face value of the company. But does that mean that you will be receiving the face value when the company winds up the operations? Absolutely not. Can you receive an amount less than face value? Yes. Can you receive an amount more than face value? Yes. Face value does not matter. So face value, what is the role of face value? Sure, Bharat. What is the role of face value? The role of face value is it is used to declare the corporate actions. For example, 100 rupees of face value I'm declaring as dividend. तो जब कंपनी ने डिविडेंड डिक्लेयर किया, when the company declared a dividend, 100% of 10 rupees, it came out to be 10 rupees only. Or let us say 50% of 10 rupees, it came out to be 5 rupees. So 5 rupees divided by 1500 rupees is called the dividend yield. That's a general formula that you do not need to know per se. You need to per se know the definition of face value. भरत मैं आपके लिए एक बार हिंदी में रिपीट कर देता हूं इसको. फेस वैल्यू होती है नॉमिनल वैल्यू पर शेयर, एक ऐसी वैल्यू जो कंपनी की बुक्स ऑफ अकाउंट में लिखी हुई है. ये कंपनी डिसाइड करती है. ये 10 रुपी हो सकती है, ये 5 रुपी हो सकती है, 2 रुपी हो सकती है, 1 रुपी हो सकती है, ये कुछ भी हो सकती है. इसके बेसिस पे कॉर्पोरेट एक्शन डिक्लेयर किए जाते हैं. बस इतना हमें मालूम होना चाहिए. एंड दिस इज डिफरेंट फ्रॉम करंट मार्केट प्राइस. दिस इज डिफरेंट फ्रॉम बुक वैल्यू. बुक वैल्यू इज बेस्ड ऑन एसेट्स एंड लायबिलिटीज वाला वैल्यू, while face value is not linked to asset and liability. Neeraj, a company can have a 100 rupees face value also. I wouldn't be surprised अगर ऐसा नहीं होता. ये कंपनी कंट्री स्पेसिफिक रूल्स हो सकते हैं. I would say नीरज it's a common parlance कि मतलब common perception ऐसी ही चलती है, लेकिन ऐसा कोई रूल नहीं है मेरे ख्याल से. कोई चार्टर्ड अकाउंटेंट शायद बता पाए इसके बारे में. आई एम नॉट द सब्जेक्ट मैटर एक्सपर्ट देयर. So the value based on assets and liability is called book value, which we are not bothered about. Now let us come to the second topic. And if there is any question that remain unanswered, keep it handy. OHLC, open, high, low, close. I would like to take you to some practical aspect now. As in, it will be easy for you to recall everything, remember everything, if you see all these terms practically. I hope you are able to see my screen, right? I have opened NSE India. It will be easy for me also to pick up pace there, and it will be easy for you also to see everything live. Let us pick up this one share, for example, Apollo Hospital. So the company's face value would be written somewhere on the page itself. ये लिखी 5 rupees. One of you is saying that you are not able to see the screen, but I hope all of you, Rangarajan sir, Kumar Appan, Prabhu, you are able to see, right? Okay, perfect. Perfect. See, the price at which the stock opens, though per se you will not be asked questions about OHLC and these terminology. Let me tell you very frankly, you will hardly be asked about only some of these terms. You can be asked about price band. You can be asked about short selling. You can be asked about VWAP. ये तो anyways, these are important topics. These are very important topics. These are terminology. So you can be asked about some of these terms directly, but most of the time it will only be the application which you will be asked about. The price at which the stock opens during the day is called open price. The highest price touched during the day, high price. The lowest price touched, low price. And the current market price is also called the last traded price. Whenever the market is open, it is called the current market price. When the market closes, it is called the LTP, last traded price. Now, these are very basic terms. I do not think anyone needs an explanation to this. There's an important term which is VWAP. So whenever, listen to me carefully. For example, so you purchased 100 Maggies at 15 rupees. For example, you are a wholesaler of it. 1,000 Maggies when you were finding it cheaper. Even more when you were finding it further cheaper. And you needed more quantity, so you bought it here. Arun, later please, we are going to discuss that. Guys, quickly, you have got 2 minutes with you. Tell me what is the average purchase price of Maggie for you? 1 minute, quick. What is the average purchase price of Maggi for you? Equal to this multiply by this. Total amount spent. Total Maggi's purchased. 13.72 is the average price. I've got just a couple of correct answers probably. Now instead of Maggi, replace it with a stock price. And this 13.72 is VWAP. It is the volume adjusted price of the stock for the time period so far during the day. Listen to me carefully. I'm repeating the definition once again. It is the volume adjusted price of the stock for the time period since the beginning of the day, which means it is only an intraday or kind of a daily data. It changes every time whenever the stock is traded at certain price different than the volume weighted average price. Sounds good to everyone? Yes or no? So this was the VWAP of Apollo Hospital on Friday. Now listen to me very carefully. The last 15 minutes volume weighted average price becomes the closing price of the day. So we have talked about various terms. We have talked about open, high, low, close, LTP, CMP, VWAP, and also the closing price. I mean, open, high, low, LTP, CMP, and the closing price also. So open price, the price at which the stock opens, high price, the highest, low, the lowest, close is the not the LTP. Closed is basically close price is basically the VWAP of the last 15 minutes or 30 minutes, depends upon the product basically. And this was the last traded price. Because generally there is no difference between CMP and LTP. When the market is open, we call it CMP. When the market is closed, it is called LTP. But at our level, from examination point of view, they both are same. Chaliye, let's proceed now. What is traded volume? The total number of shares traded during the day is called traded volume. Again, a daily data. Monday morning, the data will start from 0. What is traded value? The total amount of shares traded. The total amount of money that exchanged hands is called traded value. Amol, closing price is the closing price for the day. Not every 15 minutes or 30 minutes. It is the closing price for the day. So once the day has closed at 6:15, the exchange releases the closing price of all the stocks. And that becomes a mark on the rock for this entire life. So these are the number of shares traded. So yesterday, 3.78 lakh shares exchanged hands. 100 were bought by me and sold by Amol. 2000 were bought by Vishwesh and sold by, for example, Kaushik. So 100 plus 2000, 2100, and so on and so forth. Collectively 3.78 lakhs of this company. And then, किस price पे हुए? Total value कितना exchange हुआ? That is a traded value. So traded volume, traded value. All these were simple terms. Now let us move on to relatively complex terms. Not complex basically. One buyer plus one seller is equal to one share and is equal to one trade. Okay, there's one question I'm taking here. So, for example, let me take you through some practical aspect here. If this 125 shares get traded at certain price, then this 125 shares sold, 125 hypothetically bought, So 125 shares traded, multiply by, for example, 7,000 rupees. So 125 multiplied by 7,000 is equal to traded value. Got it? Now, we all know what is market cap, right? It is the total value of equity of the company. If you want to purchase the company, see, there are different ways of purchasing a company. You can buy all my assets, pay off my liabilities, or you can buy me from the equity side. So if you buy it from the equity side, you should be knowing my market cap, because you will be purchasing my entire equity. And what is the value of this entire equity? That is called market cap. So the total value of equity of the company is called the market cap. There are two types of market cap. Can you all please write down in the chat box what are the two types of market cap? The total market cap and the free float market cap. The total outstanding shares multiplied by current market price is equal to total market cap. The free float shares multiplied by current market price is equal to free float market cap. So what is the definition of a free float share? Total market cap minus restricted shares or letter stock is called free float shares. What are restricted shares? The shares which are held by the promoters. These are called restricted shares. There can be certain other form of restrictions also. So total outstanding shares minus restricted shares is equal to free float shares. Free float shares multiplied by current market price is equal to free float market cap. There are three types of companies based on market cap: large cap companies, mid cap companies, and small cap companies. Top 100 large cap, next 150 mid cap, rest all small cap. I am repeating the definition of market cap. So market cap, sorry, TOS and FFS. Sure. Let's talk about Reliance here. So total valuation of Reliance is 19.8 lakh crore. Out of which around 10 lakh crore के जो shares हैं, which are held by the promoter and the promoter family. So they have a restriction to be sold. I am sure you would have heard of some deals called bulk deals and block deals, right? So there are three kind of deals: bulk deals, block deals, and insider deals. Whenever someone buys or sells shares which are to the tune of more than 0.5% stake in the company, it is called bulk deal. Whenever they buy or sell shares to the tune of more than 10 lakh shares, sorry, more than 5 lakh shares or more than 10 crore rupees worth of shares, it is called block deal. And whenever the insider of the company, a manager, an employee, a promoter, or a director with a certain stake in the company, whenever they sell their stake in the company, partially or completely whatsoever, then it is called insider deal. Insider trading is illegal. Insider deal is not illegal. Insider deal is illegal only when you are in a possession of certain price sensitive non-public information. So insider deal becomes insider trading when an insider buys or sells the share when they are in the possession of certain price sensitive non-public information. Now, the promoter group shares will come to the market only through these kind of deals. So they are restricted shares. The rest shares which are floating in the public domain held by you, me, mutual fund, FIIs, DIIs, all of them, these are free float shares. They can be sold easily. This is called free float shares. Free float shares multiplied by current market price becomes free float market cap. And total outstanding shares multiplied by current market price is equal to total market cap. Sounds good to everyone? Yes or no? Now, the top 100 companies are large cap. Amol, was it too fast? I thought I mean, okay. Anyways, see, if you have not understood bulk and block, that is not part of your syllabus. It is only that, I mean, I was talking to you because I was explaining one concept. Okay, last part was which one? Insider. Acha, float wala. Okay, I thought you were already aware of this, but no worries. Float is the shares held by the promoter group or any other restrictive entities defined by the regulator. These are called restricted shares. Total outstanding shares minus these restricted shares is equal to free float shares. The free float shares are held by you, me, FIIs, DIIs, of course, mutual funds. All of these are free float shares. These number of shares multiplied by current market price is equal to free float market cap. Vishwesh and Amol, clear? Now, based on market cap, companies are of three types: large cap, mid cap, small cap. Technically, large cap, mid cap, small cap. Top 100 companies, large cap. Next 150, mid cap. Technically, rest all are small cap, technically. But then in common parlance, we have recently started using a new term, which is micro cap. So 250 to 500 are commonly called as small cap, and beyond 500, they are called micro cap. Up to Nifty 500 shares, up to Nifty 500 stocks, India की more than 92% market cap is covered. So these are important companies. Beyond 500, they are very, very small companies. Clear, guys? So I have been talking for a very long time now. We have talked about face value, OHLC, LTP, CMP, VWAP, traded volume, traded value, market cap, types of companies based on market cap, and certain practical examples. I am pausing here for 10 seconds now. Ask me any question on whatever we have discussed, but only around whatever we have discussed. Something you have not been able to understand or some follow-up question. VWAP is for the daily basis. So tomorrow there will be a new VWAP. It's a intraday data. Rajesh, insider trading is whenever the promoter, director, employee, or manager, whenever they buy or sell the shares of their own company, it is called insider trading. It is sorry. It is called insider deal. It is called insider deal. While when anyone is doing so, when they are in possession of certain price sensitive non-public information, for example, company को order मिलने वाला है, something like this, it becomes insider trading. Insider trading in India is illegal. Insider deal is not illegal. Relevance of VWAP, Prabhu, not for us, but for traders, especially intraday traders. So beyond the context of this course here. Pramod already discussed bulk, block, insider, repeating it quickly for you. Bulk, trading of more than 0.5% stake in the company. Block, more than 5 lakh shares or more than 10 crore rupees worth of shares, whichever comes earlier, block deal. Insider, I just discussed. Pramod, clear? Rajiv, restrictions of promoter holding, they have to sell it through bulk and block deal, right? क्योंकि stake बहुत बड़ा है उनका, वो एक एक शेयर करके नहीं बेच पाएंगे ना. Shailendra ji, what is the importance of VWAP in trading? We will be deviating from the topic. Can we skip this for now? Rajiv, percentage of minimum holding, I'm not sure. I think it is 5% or so, but I'm not sure. Not my domain. I mean, you may study under company law there. Because I'll be sharing some notes with you, but not at the end of every session. I'll be sharing the notes with you at the end of the program. We will be talking about various MCQs, and I'll be sharing this Excel sheet with you. Allow me a second. Sorry. Kumarappan says, but we see VWAP for other time frames also from charts like TradingView. Kumarappan, you may वो previous data carry forward कर रहा है, इसलिए you can see that. But I said relevant for intraday traders. Because I am a trader, I am an active trader for the last 17-18 years. कल का डेटा किसी काम का नहीं होता हमारे लिए 99% केसेस में. I hope I've answered all the questions. Good to proceed now. Vikas VWAP. Can we skip this, please? Allow me a second. Yeah, I'm sorry. Rajiv, as per the current requirements, a promoter has to reduce the holdings to 75% within a stipulated period. So can they have it? Yes, but there are restrictions to reduce it within a due time. The broader answer, the bigger period answer is no. For a listed entity. चलिए, let's proceed now. Let us talk about some of the important terms जिस पे आपको चेक किया जा सकता है. Arun, your answer is absolutely right. That is what I mentioned after a certain period. To begin with, for example, the government entities have 90% holding, but then the SEBI's rule kicks in. Okay, now the topics that we are going to discuss, these were the basic topic. You might not be asked directly, but as discussed earlier, these are the three topics जिस पे आपको directly पूछा जाएगा. See, अच्छा, before I proceed, do we have anyone who does not know what is short selling? Through this question, I am trying to understand a few more things. Okay, Prabhu does not know. Anyone else? So there are a few of you who have never tried short selling, do not know short selling. Cool. For example, this is a pen. So you expect the price of this pen to increase from 50 rupees to 100 rupees. This is a normal buying. We generally call it going long. So जैसे doctors होते हैं ना, they use in common parlance, they do not say that take Dolo or take Crocin. They say take paracetamol. So the technical term for this antihistamine or antipyretic is paracetamol. The same way in finance, the technical term for buying, we generally do not use the word buying. We say I have gone long, or I am long, or I am bullish. So when you buy something at a cheaper price to be sold later at a higher price, this is called going long. This is aam zindagi. But in stock market, we have a mentos zindagi. Jahan par you can also make money by betting on the prices going down. In a common life, in a normal life, you expect the price of this pen to go down. You can't do anything because you do not have this pen. You can't borrow this pen from someone. But in the stock market, you can borrow the shares from someone. Not a very complicated process. Rather, within a fraction of a second, you can do so. So the broker lends you these shares. If you have an expectation of certain prices going down, hypothetically, let's say Reliance Industries, during intraday, you expect the prices to go down from 1500 to 1400. You sell the share first to be bought back later. It is called short selling. So selling something without owning, selling something in anticipation of a price fall is called short selling. You make money when the prices go down, you lose money when the prices go up. So in short selling, and there's a common myth that short selling is only for intraday. No, listen to me carefully. Short selling is not for only intraday. Short selling in the shares, and that too in India, is allowed only for intraday. The short selling in shares and the short selling in derivatives, which we are going to discuss later, they both are available. They both can be done for more than one day. Like in Singapore markets, I used to trade the short selling can be done for 35 days. The short selling in one share of Reliance hypothetically can be done for 35 days. But in India, the short selling in shares, cash market, is allowed only for intraday. So technically, it is not a mandatory requirement. It is a regulator's requirement. Point number one. Point number two, in short selling, you make money when the prices go down. You lose money when the prices go up. It means short selling, if the question says, because there can be a question like this, that is short selling riskier proposition compared to going long? Yes, it is. Because in going long, when you buy, your profits on the upside are limited or unlimited, while the losses on the downside can be limited to the price that you have paid. Though, of course, it is a very huge amount, or it can be a very huge amount, but it is a limited amount. While in short selling, when the prices go down, you make money, but they can go down only until zero. So your profit is limited, while your losses can be unlimited, क्योंकि upside unlimited हो सकती है. So technically, you should be aware of these two things, because the question paper will be around Indian markets. So if the question says that short selling is allowed only for intraday, yes. The short selling in the cash market is allowed only for intraday, but for derivative market, it can be carried forward for many days. And in short selling, is it riskier proposition? Yes, it is riskier compared to the long position. You make money when the prices go down, you lose money when the prices go up. And for example, I am bearish on Reliance Industries for Monday. Hypothetically, I will short sell Reliance Industries at 1464 and I will cover it if the prices go down at 1460. I will make 4 rupees per share and I will be losing money if the prices go up. Make sense? This is an important concept, so I would be going slow here. If you have any question about short selling, you can ask me here. Why they should do all these? Prabhu, you mean to say why they have allowed the short selling? Or why would someone do the short selling? Okay, short selling is an important aspect of the market, because what if you are expecting, okay, so for example, Prabhu, you are holding 1 million shares of Satyam Computers, and all of a sudden you hear about a fraud about Satyam Computers or Kingfisher Airlines. How are you going to protect yourself? So what you can do is, as soon as you hear about a fraud, you will short sell this share. It was 7th of January 2009. Satyam prices went down from 186 rupees from the high to around 6 rupees 40 6 rupees 40 paisa at the bottom. What would I have done when I was trading there? And this I'm telling you very practically. I was trading. Ankit, short selling does not require a higher capital. In cash market, no, it does not. You are talking about the short selling of options that we are going to discuss later. Vikas says basically it's a hedging tool. Because I would slightly disagree with this also. It can be used as a hedging tool. It is also a speculative tool. Varadraj, the derivative short selling is allowed for multiple days until expiry. What is expiry in derivative? We are going to discuss later. Derivative in cash market is allowed only for intraday. To hedge or cover yourself from falling stock price by short selling in the derivative, yes, that can also be done. I hope I've answered all the questions. Sachin says, can I short sell a non-FNO stock? Yes, it depends upon your broker basically. A broker can allow you, Arun, a broker can allow you to short sell the non-FNO stock for intraday. Anyone else? Any other question? Again, I'm repeating, that's an important concept because we are going to use every now and then in almost all our statements in derivative, we'll be using this term short selling. Cool. Let's proceed. Price bands. So there is a stock. There is stock. For example, Hypothetically, let's say there is a client of yours who retired only yesterday, and he has got a gratuity amount of or some amount of 1 crore rupees, and he purchased a share, a very small category share, a small cap share, a micro cap share, a risky share for, let's say, 70 lakh rupees. Is it recommended? Of course not. Is it suggested? Of course not. But people do this all the time, or people may do this, make this mistake. Can we protect these kind of investors? Yes, by putting a risk management system in place, which is called price band. So what we are going to do is we can restrict the stock price from going down by, listen to me carefully, 2%, 5%, 10%, and 20%. These are 4 price bands. All the shares, all the non-FNO shares are a part of this kind of price band. It can be 2, 5, 10, or 20, which means all these non-FNO shares will remain within this band. What may come? War हो जाए, natural calamity आ जाए, God forbid, कुछ भी हो जाए, the stock will not go beyond this point. Let me show you through an example here. Reliance is a FNO stock. Sri Leather is a non-FNO stock. You see the price band is 20%, 2, 5, 10, and 20, which means if the yesterday's closing price was 240.89, the stock can go up to 289.57 today or 193.04 today. Based on the market cap and the volatility of the share, the regulator has given a set of rules to the exchanges. Based on this, the exchange decides the upper band and the lower band for the next day. So before the next day's trading start, the exchange gives us the list of all the price bands of the company and the changes in the price band. Am I clear, guys? So this is called upper circuit. This is called lower circuit. This is called upper band. This is called lower band. And collectively, both of them are called price bands. Again, I'm saying 2%, 5%, 10%, 20%. There's an important aspect to it. You will not be asked about this in the exam though, but you should be aware of this, is that, for example, a stock is hitting a 20% price band. Think of an animal in a cage. The animal has become very, very volatile, very, very wild. So what you do is you reduce the size of the cage. You make it to 10%. Then you make it to 5%. So the price bands keep on changing like this. एक स्टॉक जो रेगुलरली 20% प्राइस बैंड हिट कर रहा है, उसका प्राइस बैंड इज रिड्यूस टू 10%, then 5%, then 2%. Once it stops hitting the circuit, the price band again increases. Sounds good? Annual volatility is the expected volatility in the stock for the coming year based on the historical volatility, the data that we have. Yes, Vivek. Are we good to proceed, guys? So we are now clear with short selling and we are clear with bands. Bands, I'm repeating once again, Venkat, for you. Kumarappan says, which means it can go down by 44%. Based on historical volatility, the stock can go 22% up, 22% down in the coming year. So a total band of 44%. I believe you would have heard of a term called VIX, Volatility Index. Volatility Index is primarily for index, Nifty, but these volatilities are calculated for stocks individually also, which makes it annualized volatility. You can calculate the daily volatility out of this also. Okay, I'm recapping the bands for everyone's benefit here, and then I'll take the questions if you have any. So what are bands? Bands are basically predefined set of levels जिसके beyond a stock will not go today. For example, yesterday's closing price was 240.89. 240.89. So equal to this into 1 plus 20% equal to this into 1 minus 20%. 289.07, 192.7 or 289. 29.07 should be the answer. ओके ओके, ये प्रीवियस टू प्रीवियस वाले से निकाल रहा है. इट इज 241.31 शायद, क्योंकि अभी अपडेट नहीं हुआ होगा. या सो डे बिफोर यस्टरडे द प्रीवियस क्लोज वाज दिस. So 20% price band. Yesterday ka upper and lower band was 29.57 and 193.05 or 04. Am I clear? So this is upper circuit or upper band, and this is lower circuit or lower band. What may come, the stock will not go beyond these bands. Kumarapan, VIX is not important. Let's skip this for now. Please ask me questions around short selling or price band. No, Venkat, if the price band is 10%, then the circuit filter would have been looking like this. So the price bands are defined by exchanges and they mostly remain constant unless until the stock volatility changes. It is applicable to all the companies which are in non-FNO segment. For FNO segment, they have a cooling off period. Mayur, I'm coming to that. For a FNO segment, as Mayur said, sometimes the stock goes beyond the limits. It is only for the stocks in the FNO segment because they do not have a price band. They have a cooling off period at these levels. Okay, guys. और इंडेक्स का सर्किट लिमिट जो होता है, दैट्स एन इंपॉर्टेंट क्वेश्चन. यू विल नॉट बी आस्क्ड अबाउट दीज नंबर्स दो, बट यू शुड बी अवेयर ऑफ द कॉन्सेप्ट. सो इंडेक्स सर्किट ब्रेकर्स, ये एनएससी की वेबसाइट पे देयर इज अ लिस्ट. यस अरविंद, नो डिस्क्रिशन अलाउड बाय एक्सचेंज टू एक्सचेंज. तो ये लिस्ट है. नो वन इज गोइंग टू आस्क यू दिस नंबर, डोंट वरी अबाउट इट. यू शुड ओनली बी अवेयर ऑफ कि क्या हो सकता है. Got it, guys? Now I am pausing here for 30 seconds. Any question around any of these terms, feel free to ask. Though I believe I've answered all the questions. Nisha says, has it ever happened any time in history, circuit breaker index? Nisha, 23rd of March 2023, oh sorry, 23rd of March 2020, COVID peak, when the lockdown was implemented, Nifty hit the lower circuit. 18th of May 2009, Manmohan Singh Saab became the PM for the second time. The Nifty hit the upper circuit. 21st of January 2008, when I saw my first trading bankruptcy, the market hit the lower circuit. That is where I entered the market. I started learning about all this. Bankruptcy does not mean कि खाने के पैसे नहीं थे. Bankruptcy only means कि trading के पैसे खत्म हो गए थे सारे. So perfect. Rajiv and Kumar, VIX का टॉपिक इंपॉर्टेंट नहीं है. For the next 1 minute, I am talking to you about the VIX only for the sake of understanding purpose. VIX tells you the volatility of the index. The annual volatility tells you the volatility of the stock. Nothing else is something that you require. No calculation is required. Nothing. So don't worry about it. But yes, there is a calculation available. Google पे formula available है. It's a complicated formula, very complicated formula. Because the VIX is calculated from the option prices. Anil says price band of the stock, does it change regularly? Not very regularly, but yes, it changes. It does change. Does block or bulk deal go through beyond the price bands? Not allowed. Vijay, that's a very important question from practical standpoint, from a knowledge standpoint. Block deals can only happen in 1% up and down compared to the previous closing price. The term which is important for you, you may all write down. It is BRP, block reference price. कल जिस रेट पे स्टॉक क्लोज हुआ था उससे 1% ऊपर और नीचे आपका बीआरपी होता है, ब्लॉक रेफरेंस प्राइस. इसके बियॉन्ड कोई ट्रेड नहीं कर सकता ब्लॉक डील के अंदर. Sachin, yes, you can do so, and you can do so. Sachin says, can I hedge portfolio by short call in index? You can do so, and you can do this for the end of the month or until 3 months. वैसे you can do this for 5 years also, but liquidity नहीं होती है उसके अंदर. Thank you so much, Vikas. Glad that you are enjoying. Cool. I think we can proceed now. Great, Kumar. Rajiv says gift city name change हुआ, वो कैसा, वो कौन सा है? IFSC? But नहीं, I did not understand the question. और मुझे गिफ्ट सिटी की ज्यादा नॉलेज है भी नहीं. Okay, one last question before we proceed. Sir, in the cash market, can we not sell first and then how do we short sell? The one that you sell first is called short sell only. I was trying to open my terminal here. Let me show you something interesting. I mean, it will just take 30 seconds for you, but all your concepts will be clear. Allow me a second. Guys, any of the resources which I show you on my platform should not be seen as a recommendation to buy something or sell something, because I'm showing you my broking terminal. So whatever I'm showing is only for educational purposes. So tomorrow, for example, I don't know who asked me this question. Ankit, yes. Ankit, tomorrow I expect the Vodafone prices to go down, hypothetically. I will simply go down. I will simply click on sell and initiate a sell trade at the market order or limit order or whatsoever that we are going to discuss later. तो मैं सिर्फ इस शेयर को पहले सेल कर दूंगा and I'm done. This is called short selling. Generally आप क्या करते हैं? Generally you buy. But hypothetically I do not have this share, but still I want to sell it. This is called short selling. तो अब जो पहले सेल कर रहे हो वो शॉर्ट सेल है. Cool. Perfect. Last topic in the terminology. Okay, Shailendra has a question. Sell. Here's a margin available. So for one share, I need to pay only 1 rupee 31 paisa. And how much money do I need to pay for buy? For intraday, again 1 rupee 31 paisa. Shailendra, clear? Chandra says it will not say no balance in the demat as shares. Chandra, as long as you are dealing with those shares जिसमें short sell के broker ने allow कर रखी है, no, it will not say. Like for example, I can sell Reliance. अगर मैं इसको investing के account से बेचूंगा, then yes, you do not have this share in your portfolio. But then if I select it in trading, then yes, it is not showing. Okay, guys. Cool. Order book. Last topic in this section. Then we'll be starting with index, and then first we'll be talking about the derivatives. Order book. You all go to a sabzi mandi. Think of a scenario wherein there are two queues in a sabzi mandi. The ones who want to buy the vegetables and the ones who want to sell the vegetables, the farmers. The ones who want to buy the vegetables, for example, Chandra, for example, Anurup, for example, Shailendra, for example, me, you, all of us, we are these people, the bidders. Someone wants to buy 2000 quantity, someone wants to buy 1500 quantity, and so on and so forth. While the farmers, someone wants to sell 500 quantity at this price, this price, this price. This is called the bid price. This is called the ask price. This is the bid price. This is the ask price. On the left side are the bids. On the right side are the asks. Bid prices, offer or ask prices, bid quantity, and ask quantity or offer quantity. The buyer who wants, listen to me carefully. This can be a question. The buyer who wants to buy at the highest price amongst all of us is called the best bid. And the seller who wants to sell at the cheapest price amongst all of us is called best ask. And this entire table is called order book. So listen to me carefully. Bid, ask, best bid, best ask, order book. These are 5 terms that we have discussed. Clear, guys? These are the total bids. These are the total offers. I repeat, bid, the price at which the buyer wants to buy. Ask, the seller at which the price at which the seller wants to sell. And there are hundreds of buyers, hundreds of sellers. The one who wants to buy at the highest price amongst everyone is called the best bid. The one who wants to sell at the lowest price amongst everyone is called best ask. When the best bid and the best ask, or whenever any bid and ask matches, it becomes the LTP or the CMP. It becomes the last traded price. So the last trade happened at 1464.10. Will it surely be the next traded price? Not sure. We can't say that. LTP is a historical price. Bid and ask is more futuristic data. So a trader will be using the bid ask price. And the bid ask spread, the gap between the buyer and the spread, is called the bid ask spread, or simply the spread. The higher the spread, the larger the spread, the more illiquid the security is supposed to be. The shorter, the smaller the spread, the more liquid the security is supposed to be. This ask minus bid, which is spread, divided by bid price, is called the impact cost. So basically, we need to keep the impact cost lower while trading. So what is impact cost? You wanted to buy something at 100 rupees, while जब आपने order place किया तो वो आया आपके पास 100 rupees 10 पैसे का. This 10 paisa is your impact cost. Okay. Amol, bid means buyer, sell means seller, offer means seller. Vikas says, but sir, lot of ask, bid, offer is artificial. Yes, it can be. Can we do something about it? We really can't do anything about it. You have to figure out that whether they are fake or real. That is why we have certain kind of analysis in the market. So 100 is the buyer, 101 is the seller, 99, 98, 97, 96, 102, 103, 104, 105. Spread is equal to 1 rupee. Spread percentage is equal to 1 divided by this. Impact cost is basically the LTP was 100.5. But when you went to buy a trade, the seller was available at 101. So आपको ये stock कितने का मिला? 101 में, right? Everyone understands this, correct? The LTP was 100, तो आपको दिखा LTP. You wanted to buy at 100 and 100.5 and you immediately placed an order to buy at immediate price. But you were able to buy at only 101 because the seller was available at 101. So that increased your cost. This cost is called impact cost. The difference between the price at which you wanted to execute and the price at which it got executed. With these words, we are done with this important topic, which was capital market terminology. Shailendra, yes, impact cost is applicable only for market order. As I said, you wanted to buy immediately. That is, we are going to discuss in the after basics of derivatives, order management system. Okay, guys. Now we will be taking a break here because we have to start a very, very important topic, a very intriguing topic. I would say this is the most important topic that we are going to start now in this entire course. And this will continue for a very long period. So if you miss the basics, you might be missing a very important aspect. So please make sure to be attentive during this program, during this topic, which is derivative. Achha, nahi, sorry. Abhi usse pehle I have to talk about index. ठीक है, index. I'll be talking about index for a while, and then we'll be talking about derivatives. So around 5 to 10 minutes, I have to talk about index. Then we'll be starting with derivatives, and derivative is a very important topic. So let us first cover the index, and then we'll take a break. अभी break नहीं लेते हैं, index लेकर फिर break लेंगे. 10 मिनट और पढ़ लेते हैं. Good with everyone, right? Sorry, I raised some hopes of break and then I killed them. Please repeat order book concept again, bid, ask and spread. The list of all the buyers and the sellers is called order book. The highest bidder is called the best bid. The lowest offer guy is called the best ask. और ये total list को कहते हैं order book. Viren, clear? Shubham, there are a few more concepts I want you to digest first, this entire thing. Then we will see the application part. See, OMS, order management system, is application of whatever we have discussed. So I want you to absorb this first. Then I'll be coming to this OMS topic. Chaliye, now let us talk about an important aspect before breaking. If you want to know about India's equity market or India's economy, how will you get to know beforehand that economy is likely to grow? GDP is a lagging data. You will get GDP very late. What is the leading indicator? PMI is certainly a leading indicator, Prabhu. See, if the economy has to grow later on, it means people will be consuming later on. Someone will be, how will people consume later on? When someone will already be producing today. So when someone is already producing today, then there will be someone in the world who would already be aware कि इनके products बिकने वाले हैं. आप नोटिस कीजिएगा हमेशा एसी कंपनी के प्राइसेस समर्स में नहीं बढ़ते जब एक्चुअल डिमांड आती है, समर्स आने से पहले बढ़ते हैं. एग्रीकल्चर प्रोडक्ट्स के प्राइसेस हार्वेस्टिंग से पहले चेंज होते हैं, हार्वेस्टिंग के बाद नहीं होते हैं. So the stock market is a leading indicator of the economy. लेकिन how will we get to know? Varadraj, yes, capex is a good idea, but capex can be wrong also. So stock prices are considered to be the most leading indicators of the market. But which stock prices? Reliance, Asian Paints, Apollo Hospital, HCL, TCS, Wipro, Sun Pharma, Dr. Reddy, what? Nothing actually. A basket of all these products. Because if India grows, then they will be consuming more petrol, more electricity, more vehicles consumption, more paints done at home, more tour and travel, more purchase of clothes, more internet consumption, and so on and so forth. So let's make a basket of all these securities, and that is called an index. Now listen to me very carefully. The topic that we are going to discuss now is a very important topic, and I am at least 80% sure that you will be getting at least 1 or 2 questions from this topic in your exam. What is an index? An index is a basket of securities that follow certain criteria to represent the picture of entire economy or a particular sector. I repeat, an index is a basket of securities that follow certain criteria to represent the picture of entire economy or a group of companies or a sector basically. So based on this, the index can be of two types. One, sectoral index. Second, benchmark index or broad-based benchmark index. An index that comprises of all the sectors is called broad-based index or benchmark index. For example, Nifty 50. For example, sensitive index. Any other index that you can think of? Benchmark example? Correct. Nifty mid cap, etc. Now, based on the formula, remember I talked about a formula? They follow a certain formula to represent the picture of entire economy or a sector. इस formula के ऊपर generally the questions are asked. There are certain formulas. वो क्या होते हैं? One, the index was formed. सबसे पहले जो index आया था वो था equal weighted index. Give equal weightage to all the stocks in an index. Do you think it will represent the economy in a perfect way? I doubt. Because not all the companies contribute same towards the economy. Then you got price weighted index. Then you got volume weighted index. यहां पर सबको सेम वेटेज मिलती है. यहां पर the higher the stock price, the more the weightage. The higher the volume in a stock, the more the weightage. Fundamental weighted index. Market cap weighted index. Free float market cap weighted index. The one इसमें equal weightage, इसमें the higher the stock price, the higher the weightage, the more the volume, the higher the weightage, the better the fundamentals, the higher the weightage, very subjective. The higher the market cap, the higher the weightage. A refined version of this is, which is currently used, the higher the free float market cap, the higher the weightage. Clear, guys? So now I am pausing here. Prabhu, I'm repeating. Equal weightage to all the stocks. Higher the price, higher the weightage. For example, MRF is given more weightage compared to Reliance. The higher the volume in a trade, the higher the weightage. So we will be calculating the last 6 months average volume. जिसका ज्यादा होगा उसको ज्यादा weightage provide कर देंगे. जिसके fundamental अच्छे, we will select some 4-5 parameters. जिसका market cap ज्यादा, उसको ज्यादा weightage. Again, the market cap of the last 6 months or 3 months, जो भी आप formula decide करते हैं, exchange decide करते हैं. Then you have free float. So in India, Kaushik ji, in India, all the indices, or at least I can say 90% से भी ज़्यादा indices are all free float market cap weighted index. Even the sectoral ones also are free float market cap. तो बैंक निफ्टी में भी जिन बैंक्स का फ्री फ्लोट मार्केट कैप सबसे ज्यादा है उनको ज्यादा वेटेज मिलती है. So in India, we are mostly following free float market cap with sectoral capping and a stock capping. For example, in Nifty, we cannot have, for example, or Nifty mid cap 150, we cannot have, hypothetically, just a hypothetical number, you cannot provide a weightage of more than 30% to one sector or more than 10% weightage to one stock. ये restrictions हो सकती हैं, but broadly free float market cap. Mayur, we have already covered the free float topic earlier. Were you not there? So free float shares are the freely floating shares. इन्हीं shares के basis पे आपका market cap जिसका ज़्यादा है उसको ज़्यादा weightage आप दे देते हैं. Kaushik has a question, and the floor is open for everyone for the questions. Any questions around face value से लेकर index तक, all these topics we have covered. इसमें आपका कोई भी question है, more than welcome. And then we'll take a break. So in case of index funds, they follow free float. In case of index fund, they follow index. The index is following free float market cap weighted method. Venkat, order book doesn't necessarily constitute executed order. Order book necessarily constitute unexecuted orders only. Executed तो order book में आएंगे ही नहीं ना वेंकट. They would be out of the order book. They have already been executed. अनुरूप, the block deal का जो time होता है ना, it is 8:45 AM to 9 AM in the morning before the market timing starts for V people. So of course the block deal will not be a part of order book. Prabhu, so with all these weighted index criteria, stocks are selection to the index, right? There is an important resource I can share with you, very interesting resource actually. Open this website, niftyindices.com. Away from the topic of the exam, you see how many index NSE manages? These are broad-based index. These are all sectoral. These are all thematic. These are all strategic. Then sovereign green, SDL, corporate, municipal, money market, etc. etc. Let me show you something really interesting here. अब मैं निफ्टी पे क्लिक करता हूं यहां पर. Have a look at this page. ये देखिए फाइनेंशियल सर्विसेज की वेटेज कितनी है, देन यू डबल क्लिक ऑन दिस, कौन से स्टॉक की वेटेज कितनी है, एंड सो ऑन एंड सो फोर्थ. वेरी इंटरेस्टिंग वेबसाइट. Okay, let me answer last few questions, then we'll proceed. We'll proceed for the break then. Bulk and अच्छा, so with all these, अच्छा ठीक है, how to identify bid or ask is better in buying and selling? Rajiv, it is not that easy. Not that easy. I cannot answer this question here. It's a very long topic, but a complex topic. Nikhil, market cap is basically, you mean to say market cap weighted index, right? Market cap weighted index is the higher the market cap, you give more weightage to this stock in the index, and vice versa. Biren say explain circuit breakers. Basically, they are the limits beyond which a stock or an index cannot move during a day. Biren, clear? Kaushik, block and bulk deal happen before the market hours. Block deal happens before the market hours. Basically, there are two timings of block deal. No one is going to ask you in the exam though. 8:45 AM to 9 AM and 2:05 to 2:20 PM. बट देन अगेन वो ऑर्डर बुक में नहीं दिखता। और बल्क डील जो होता है वो ड्यूरिंग द मार्केट आवर्स कभी भी हो सकता है, लेकिन वो भी आपको ऑर्डर बुक में नहीं दिखेगा। Mere fixed income securities for now is not required. We are going to discuss fixed income later. Kaushik, every 6 months the index composition changes or is supposed to change if the changes are required, but no discretion, only formula. There is an index committee in NSC. Bishwa, please explain quantum of risk with short selling with a live example. So if you short sell Reliance Industries on Monday, and let's say the stock prices shoot up, then that is your that's a huge loss. Theoretically at least. Practically same सा risk होता है buy और sell side पे. Practically ज्यादा difference नहीं होता. Rajesh, we have already covered bulk and block. Bulk is 0.5% exchange of equity in a company, and block is 5 lakh shares or 10 crore rupees worth of shares. Okay, guys. So I hope I've answered all the questions. Because we are just taking a break. और उसमें आपकी चाय खत्म भी हो जाएगी. We are taking around 15-20 minutes break. So I hope we are good to go now. I mean, we are good to proceed with the break. No questions. Wonderful. So it's 12:57. We are meeting at 1:15. 1:15, 1:5. Cool. Thank you so much. Relax yourself. It is going to be a heavier one for the last 1 hour. Derivative is an important or and difficult topic. Guys, are we good to start? Okay. Let's study for another half an hour, and then we will be trying some mock questions also. Though we will have a detailed mock questions also, but then here also we'll try to solve some of the mocks while we are together here. Anyone, any question? We are starting in a minute. चलिए. So, Rajesh ji, we will be starting with such basics itself. Don't worry about it. Yes, Birenji, I think the fees is, as far as I can remember, it was 3,000 rupees shayad. 3,000 was the fees. And NISM की website पे जाके, you just have to enroll it. Anil, though I am using many examples, but I would like to use more examples. I'm deliberately using more examples or giving more examples from the topics from which I expect some questions. The topics from which I am not expecting any question or which is not part of your curriculum, there I am skipping deliberately. That's by choice. That is why I said that whenever you have some other question pertaining to the subject, I would like to take it up, but then because it is not pertaining to the exam, so maybe we can talk about it separately at the end of the session. Biren says, does NISM provide their own material for preparation of this exam when we pay fees and schedule exam? They provide you the 3 online books: equity derivative, currency derivative, and interest rate derivative. That's it. ओके, चलिए आगे बढ़ते हैं. सो पेट्रोल, बटर, bread, shoes, t-shirt. What are the similarities in, what is the similarity in all these products? What is a common ground? Consumption. Okay, we all consume all these things. Consumables, byproducts. Okay. Consumption, perishable. Tangible. Okay. Anything else? Price sensitive. Vishwesh, rather opposite. Oh, अच्छा अच्छा, ठीक है ठीक है. Petrol, butter, bread, shoes. Perfect, perfect. You are absolutely right. I thought I wrote it something else. Yeah. So these are the basically derivatives. These are basically derivatives wherein the underlying assets were crude oil, milk, wheat, leather, and cotton. All these products are derived from something called underlying asset. The same concept of derivative word English is what we use in finance. The only difference being that derivatives in finance are not the physical or tangible products like these. They are the contracts. So what are derivatives? A derivative is a, listen to me very carefully, and if you may write down the definition also. It's an important definition. What is a derivative? A derivative is a contract between two parties, a financial contract between two parties where one party agrees to buy, agrees. Agreement is a very important term because nothing exchanges hands today. It is only the agreement that happens. So what's a derivative contract? It's a contract between two parties where one party agrees to buy, other party agrees to sell a predetermined quality and quantity of an asset at a predetermined price and time. I repeat, a derivative is a financial contract between two parties where one party A agrees to buy or sell, A agrees to buy from B, who agrees to sell a predetermined quality and quantity of an asset at a predetermined price and time. The easiest way to understand the basic idea of derivatives is to see all the real estate transactions that happen around you in India. So there are two parties, for example, A Arun and let us say K Kaushik. So Arun agrees to buy an apartment and Kaushik agrees to sell that particular apartment at a price of 1 CR 3 months from now, a particular type of flat or apartment with yellow paint, with white paint, 2 BHK, 3 BHK, whatsoever. So that's the quality. So long party agrees to buy from short party and short party agrees to deliver to the long party a predetermined, जहां पर underlying asset हमारा हो गया apartment. So this is a underlying asset. This is the tenure or expiry of an option. Party is long or short or buy and sell. So a derivative is a contract between two parties wherein one party, Arun, agrees to buy an apartment from Kaushik at a predetermined price, at a predetermined time, and of course a predetermined quality. This is a derivative contract. A derivative contract. Now listen to me carefully. Based on underlying assets, the derivatives can be of different types. So I would say the derivatives can be classified, one, based on underlying asset, based on platforms, based on participants, and based on products. Based on underlying asset, equity derivatives, commodity derivatives, forex or currency derivatives, bonds derivative, real estate derivatives, miscellaneous derivatives. We do not use them. Hence, we'll be focusing on only these four products. Platforms, which we are going to discuss in detail later. One, OTC. Second, OTE or exchange traded derivatives. Participants, speculators, hedgers, and arbitrageurs. That's a fairly simple idea of derivatives. And the best example to understand derivatives is the property transaction that happens around your houses, around your place. That is basically an example of derivative where you pay a certain amount in the beginning or you may not pay, depends upon the parties. But you agree to buy. One party agrees to buy, other party agrees to sell a predetermined quality and quantity of an asset at a predetermined price and time. Now, when you agree to buy or sell an equity product, for example, Shark Tank India, they agree to buy equity. They might not buy equity upfront, but they might agree to buy equity. So that's a derivative. That can be a derivative contract. First, the best example to understand the derivative contract in equity is ESOP. ESOP is not an equity. Employee stock ownership plan is not an equity. It's a promise to give you equity at a later date. So that's a kind of pseudo derivative contract. Why I'm using the word pseudo, I'll tell you later. Because it does not fulfill all the condition of equity, but fulfills some of the conditions. Commodity derivative. For example, a farmer entering into a contract with Britannia to sell wheat at a later date. For example, you entering into a contract to buy gold from a jeweler at a later date. Forex derivative. Your son, your child, your daughter, you, yourself, for whatever reason, you plan a visit to US 3 months from now and your biggest risk is the currency. Because you will be consuming, let us say $10,000. But the dollar price may be different from what it is today. So you enter into a contract with a banker to buy dollars 3 months from now at a predetermined price. That's an example of a derivative contract. That's an example of a forex derivative contract. You want to purchase a house 1 year later, but you are worried that the RBI monetary policy may increase the interest rates. You enter into a contract with a bank, though it is not a common case in India, but then you may enter into a contract with a bank to take a loan at a predetermined rate. Entering into this contract today itself to take a loan 1 year later. That's an example of a bond derivative contract. Let me give you one example of all of them practically. One second. You're able to see the screen, right? The NSE website. Okay, cool. Market data, derivatives market. We are all kind of aware of equity derivative. We have heard of Nifty future, Nifty option, Bank Nifty future, Bank Nifty option, and so on and so forth. But you see, there are interest rate derivatives available. This provides you a right to buy this particular type of bond. What is this bond? It is 679 GS2034. It's a government security GS maturing in 2034, which will give you 6 rupees 79 paisa on an investment of 100 rupees for the next 9 years or 10 years. And will give you 100 rupees at the end of 2034 also. This product is available for 102.70 right now into lots, of course. The yield of this security is 6.40%. The price of this bond will go up or will go down, but there are 22,000 people already part of this bond derivative. They have promised to buy and sell this particular bond in 2034. Having said this, not a very important topic for us from practical standpoint, but from theoretical standpoint, you should be knowing that these kind of products are available in India. Commodity derivatives, crude oil derivatives, gold derivatives, silver derivative, and so on and so forth, natural gas, currency derivative, USD INR, Euro INR, GBP INR, JPY INR, total 7 currency pairs, which we are going to discuss later. These products are available in the market. Where do you see the expiry date? Expiry date of the contract or expiry date of the underlying asset? Because in interest rate, we have two kind of expiries. इसका जो expiry date है, that is 20, contract का expiry date is 26th of June 2025. और product का जो expiry date है underlying asset का, it is 2034. Venkat, clear? But बाकी commodity market में there is an expiry of only the derivative contract, 17th of July, then somewhere in August and so on and so forth. Currency also you have a derivative contract of only expiry date of only the derivative contract, not the underlying asset. There are two kind of platforms on which the derivative contracts are traded. One, think about your real estate transaction that we were talking about. That's an over-the-counter transaction. What's an over-the-counter transaction? When two parties enter into this contract over the counter with the help of a broker or through directly, but certainly without the involvement of a formal exchange. कोई स्टॉक एक्सचेंज इन्वॉल्व नहीं है इसके अंदर. जब तक ऐसा हो रहा है, आप इंडिविजुअली आपस में कर रहे हैं और यू आर मीटिंग थ्रू अ ब्रोकर, सम अदर चैनल, एनबीएफसी, व्हाटसोएवर, दैट्स एन ओटीसी कॉन्ट्रैक्ट. And when you enter into this contract through an exchange, the ones that we just saw is an example of a over the exchange or exchange traded derivative contracts. Pausing here for 10 seconds, 30 seconds. Anyone, any question on whatever we have discussed? We have talked about definition of derivatives, underlying asset, platforms. Rangarajan sir, any transaction that you conduct, जो मैंने example अभी लिया, the one which I took, buying a property, Arun and Kaushik for example are buying a property. That's an example of a over the counter contract because there is no NSE, BSE or some other exchange involved. Make sense? That might be through as a local broker. That might be directly, they might be knowing each other. Absolutely fine. Everything is OTC. Over the counter heat, over the counter and over the exchange. Yes, absolutely right. I'll be coming to this in a while when we talk about products. That these are unregulated products. Basically, the regulation, there is no formal regulator, though jurisdiction applies. The police and the CBI and the other legal authorities are involved, but then the regulator like SEBI is not involved. So futures and options are the subset of derivatives. Absolutely right. We are going to cover this in a while. Vishwesh has an interesting question. Buying and selling FX with a bank, it is derivative. Okay, guys, tell me this one answer. Vishwesh says buying and selling of foreign exchange with a bank. Those who agree that this is a derivative contract, right? Yes. Those who do not, right? No. Good point. Guys, are you tired? I'm not getting many answers now. Just 10, 15, 20 or some other number. Rajesh, absolutely right. Because the statement said that someone is buying and selling FX with a bank. You are doing a transaction today itself. Whenever you do a transaction today itself, that is not a derivative contract. Derivative has to be a agreement to buy or sell. So that is not technically, as per the statement, the contract was not a derivative contract. Sounds good to everyone? Okay, now listen to me very carefully. Important topic. And after this, we are going to practice a few questions, some mock questions that you may be asked in the exam based on the topics that we have discussed. So effectively, the last topic of today, participants, then we'll be talking about the products tomorrow and the margin calculations also tomorrow, and also important aspects, which is futures ka valuation, option ka basics, everything we are going to discuss then. So there are three different participants in derivatives market. One, speculators. Second, hedgers. And third, arbitrageurs. Now, who are speculators? I want everyone's attention, please. Whenever someone enters into this contract for the purpose of only making profit, when the purpose of entering into a derivative contract is only to make money, then this participant is called a speculator. Who is a speculator? A speculator is the one who enters the market only for the sake of making money. He always has an opinion about the market, either bullish or bearish or flat. Not having an opinion is also an opinion, as in expecting a flat market is also an opinion. I repeat. So who is a speculator? He is the one who enters the market only for the sake of making money. He can be bullish, he can be bearish, he can be long, he can be short. But he majorly has an opinion about the market, either up, down, or flat. So in our previous case, Arun expected prices to go up, Kaushik expected prices to go down. They both entered into a contract. Did they need the property? No. They were only speculating. They were speculators. Who is a hedger? A hedger is the one who enters the market. Listen to me very carefully. A hedger is the one who enters the market only for the purpose of mitigating the price risk. A hedger is the one who enters the market only for the purpose of mitigating the price risk. He does not have an opinion about the market. So for example, a farmer enters into this contract to sell his wheat at 10 rupees per kilogram. Of course, he is worried about the prices going down, but the idea is that because he has to run his house, because he has to get his child married in 3 months, so he would be requiring some X amount of rupees to mitigate that price risk. Correct. To mitigate that price risk, we enter into this contract, and then this contract becomes a hedging contract. See, the contract remains the same. It is only the thought process behind execution that determines whether it is a speculation or a hedging. For example, Indigo Airlines is worried about prices of oil going up. So they enter into this contract to buy oil, 1 million barrel oil 1 year from now. That's an example of a hedging. While if the same thing you do, you expect the prices to go up, and then you enter into this contract to buy oil, you are a speculator. Is this difference clear to everyone? Again, I am saying everything remains same. It is only the mindset that changes. So Rajesh ji, whenever someone enters into this contract, buy or sell the oil or whatever, for the purpose of mitigating the price risk, then he or she is called a hedger. While if they enter into this contract only for the sake of making money, they are called speculators. Correct, Vishwesh? The copper importer hedges for the prices on exchange. Any kind of importer for that matter. Any exporter like TCS, Infosys, Wipro, they all are supposed to be the hedger. Rajesh ji, clear? For example, TCS is worried about the prices of the dollar going down, depreciating. Sorry, dollar prices depreciating, rupee appreciating. Because they are supposed to receive $1 million. Currently, the dollar can be sold at 85. But what if in the future it can be sold at only 83? I'm in loss. Right, Rajesh ji? So I will go to the bank and talk to the bank and tell them that, see guys, 3 months later, I'm expected to receive $1 million. I do not know, you do not know what the prices will be. Let's enter into the contract. I should be able to sell my dollars to you at 84.90. आज का price चल रहा है 85. I should be able to sell you dollars at 84.90 in your favor 3 months from now. The bank is happy क्योंकि बैंक को जो $85 का अभी मिल रहा है वो बैंक को तब मिल जाएगा 84.90 पे. They are happy. So bank expects the price of the dollar to appreciate, while the TCS expects the price of the dollar to depreciate. Guys, I suggest write down 2 thumb rules of derivatives. If you are new to this subject, write down these 2 thumb rules. Rule number 1. In a derivative contract, both the parties will always have opposite expectations. Rule number 2, मतलब एक को bullish लग रहा होगा दूसरे को bearish लग रहा होगा, like in the previous case. Rule number 2, it's a zero sum game. Matlab profit of one is equal to loss of other. If the dollar prices go up by 10 paisa, the bank makes money. If it goes down, the TCS makes money, and vice versa. Sounds good? Last, who is an arbitrager? An arbitrager believes in the principle of one financial product is equal to one price. NSE pe one share is trading at 100 rupees. BSE pe that share is trading at Rajesh ji, I said two rules, two thumb rules. Rule number 1, both the parties have opposite expectation. Rule number 2, it's a zero sum game. Matlab profit of one is equal to loss of other. Okay. By the way, the second rule became my motivation to stay in the stock market after my bankruptcy. That was the very statement that I'd heard around 17, 18 years ago, which made me rethink that if I have lost this money on day one, someone would have gained it. So why I can't be that person? It took me a lot of time, but then, I mean, it was a kind of good journey. Anyways, so arbitrage. What's an arbitrage? An arbitrager believes in the principle of one financial product is equal to one price. Like NSE pay 100 rupees, so BSE pay why it is trading at 102 rupees. Someone will buy at NSE, sell at BSE. It is only a theoretical example for now. But think about, we guys or a lot of people bring gold from Dubai. That's nothing but a kind of arbitrage. I mean, kind of, not exactly, because the price there is some 5% cheaper. So as soon as you enter into a contract to buy gold in Dubai and sell gold here in India, that's an arbitrage. You have made some 5% return. But we are going to talk about arbitrage in greater detail later. And last, products, forwards, futures, options, swaps, leaps, structured derivatives or exotic derivatives. These are all the products. What are these and how they work? Everything we are going to discuss in the next session. Now, every next session is going to be more important than the previous one, because every time we'll be increasing our level. We'll be practicing the questions. Like today, we are also practicing. We are going to start with a few questions. Vadaraj, we are going to discuss all of them in greater detail. But leaves are long-term equity anticipation securities. Rajesh ji, I think until next Tuesday, not this one, the next Tuesday, tomorrow onwards, we are going to meet in the evening. You will be getting the schedule. I will be requesting Harsh to please share all these things. My session is not over yet. Please, guys, I want everyone's attention, please. Harsh, you want to say something, please?
Hi, good evening. Thank you so much, Himanshu, for the wonderful session. Partners, so we have already sent out all the registered partners email with the schedule. For the sake of reminding, I'd just like to put a note that we have our session every day, which is Monday to Friday, 6:30 to 8:30 in the evening. And for every session, in case you have not yet registered, kindly go to the events page under the partner dashboard and register yourself for every session, because that is what the Zoom process, that's how it works. So we need to just click on the register for every session. I think most of you have already registered, but some of you, if you have not yet registered for every session, please do it. So we will have 7 more sessions, 5 from Monday to Tuesday, 6:30 to 8:30, and the following week on Monday and Tuesday. And just one more update. So along with the live sessions, we've also launched a new tab on the partner dashboard where you have the NISM module and the revision notes also available along with some mock tests, right? So you can go through that also, and as you go along the course, that would be of an additional resource for you. Yeah, thank you, Mr. Himanshu. Thank you so much.
Thank you. Thank you. So guys, we are starting. Guys, I want everyone's attention here. All the administrative related queries jo hai, we are going to discuss in after 5 to 10 minutes. So let us try some questions here. And you have to be quick and you have to be correct. Consider yourself to be getting a time because these are relatively basic questions compared to जहां पर आपका actual time spend होने वाला है एग्जाम में, क्योंकि अभी the topic is not I mean basic topic cover किया है हमने. So expect or take 30 seconds time to answer each question and you should be correct. But let me tell you one thing, these are very basic questions from the exam. Quick. Simply write the option. And guys, may I please request one thing? Acha, nahi, that will be difficult for me also. ठीक है, you can share your answer publicly. But I will not be speaking for 30 seconds until all of you answer these questions. Heath, I have shared the question in the chat box. Last 10 seconds for everyone, then I'm sharing the answer. The correct answer is D. D for Delhi, D for Delta, selling borrowed shares of a stock. The correct answer is neither B, that many of you answered, nor A, that few of you answered. The correct answer is D, D for Delta. Next question, quick. Anurup, for now, I am not doing that because उसके लिए मुझे अलग-अलग screen पे करना पड़ेगा उसको. Let us take it impromptu for now. We'll figure out later. Quick. Because I'm cherry picking some of the topics or the questions जिसके concept we have discussed. So this is fairly simple. The bid price is the buyer's price, which is D. D is the correct answer. Next question. Most of you are correct. The correct answer is B. B for Bombay. When you buy a company's bond, you have lent money to the company. There is something that we haven't discussed, but I would like to share a question here. Sure, Lokesh, I'll do that also. Wait. Yeah. So whenever the yields go down, the bond prices go up. This we are going to discuss later also. The correct answer is not A, it is B. It will go up. One more question. It's also there in the Excel on your screen. I have not shared the options with you by choice. Only a few of you are correct. This we discuss in greater detail. The correct answer is 2.77%, neither 3.6% nor 10%. Last question. In the chat box and also on the Excel sheet. A very simple one. So the correct answer is not C that some of you have mentioned. The correct answer is B. Number of shares issued by the company multiplied by its market price. So guys, let us recap what all we have discussed today. We started with the basics of finance, savers, spenders, type of these people. Shailendra, the calculation for dividend yield was equal to 10 rupees of dividend divided by 360 rupees of share price, 2.77%. So we started with the basics of finance, financial intermediaries, not required, financial markets, these four products or derived products, derivative we have started. Why do we buy equity? Why does a company issue equity? Where does a company issue equity? How does a company issue equity? All the public issues, everything around the primary market. And then we started talking about the secondary market when we started to excuse me, when we started talking about the brokers. So there are two types of brokers: discount broker providing you these two services, full service broker providing you all these services. Example, calculation. Then we talked about commodity. Then we talked about terminology, face value, OHLC, LTP, CMP, VWAP, traded volume, traded value, market cap, types of market cap, types of companies based on market cap, short selling, price band, order book, index. And then we have also started talking about the derivative basics, but this concept, this topic will continue for at least half a more class. And then we talked about certain terminology around the derivatives. Index also, this is an important topic wherein what are the different types of indices. We saw the Nifty indices website. Then we talked about financial derivatives, underlying assets, platforms, participants, products we are going to discuss tomorrow evening. So this is something that we have covered today. And also we have discussed a few mock questions that were relatively easy. So I open the floor for questions. Any question that you might have, we still have 5 minutes. If you have questions, please feel free to ask. Arun, that we are going to discuss later anyways in greater detail.